Freedom isn't just about money. It's about control over your time, your choices, your life. Welcome to The Freedom Investor. Chapter 1. Why I wrote this book. Sharing my motivation to help others build wealth and step away from the 9-to-5 grind. I didn't come from money. I started investing from scratch. No shortcuts, no windfalls, no insider connections. Just me, a laptop, and a growing obsession with understanding how markets work. I remember sitting alone at my desk late at night with trading charts glowing on one screen and YouTube videos breaking down macro trends on the other. I had no financial mentors around me, just curiosity and an unshakable drive to figure things out. Growing up, I was always entrepreneurial. I ran multiple businesses, from juice bars to cafes to a manufacturing venture. I worked long hours, wore every hat in the business, and did whatever it took to keep things running. While the money was good, I didn't know what to do with it. I spent most of it going out, enjoying life, and living in the moment. I knew how to hustle, but I didn't know how to build wealth. I was raised in a traditional Asian household where the expectations were clear. Do well in school, get a respectable job, buy a house, and save steadily. My parents meant well. They were loving, hardworking, and wanted the best for me. But their definition of success, a stable 9-to-5 career, long-term job security, and home ownership, felt limiting. It didn't sit right with the fire inside me. I craved more than security. I wanted freedom, time freedom, location freedom, and financial freedom. And yet, breaking away from that script wasn't easy. Challenging the path your parents worked so hard to set you on isn't just difficult, it's emotional. You feel guilt. You feel fear. You don't want to disappoint the people who raised you. But deep inside, I felt a fire that couldn't be extinguished by playing it safe. I didn't want to follow a script. I wanted to write my own. I knew there had to be a different way to live, one that didn't involve trading time for money for the next 40 years. Eventually, something shifted. I got to a point where I felt like I was working hard with nothing to show for it. I couldn't see a way out of the rat race. Every month felt like starting from scratch, chasing the next deal, the next customer, the next invoice. The harder I worked, the more trapped I felt. It wasn't just financial pressure, it was mental fatigue. I'd go to bed exhausted, only to wake up the next day and do it all over again. That wasn't living, it was surviving. That's when I discovered Bitcoin in 2017. I put in $500, not knowing much, just following a hunch, and watched it grow. The excitement was real. That small investment flipped a switch in me. It wasn't about the money itself. It was about the possibility. It was the first time I saw my money grow on its own, without me having to trade hours of my life for it. That realization changed everything. But what I didn't understand at first, and what hit me later, was how much of a losing game I had been playing all along. Even before I started investing, I was already falling behind. I just didn't know it yet. That's because inflation is a silent thief. While I was stacking cash, hoping to one day feel financially safe, the purchasing power of my money was slowly being eroded every single year. It wasn't obvious. Nobody tells you this growing up. But the more I learned about how the financial system works, how central banks print money, how fiat currencies are designed to lose value over time, the more I realized that not investing is its own form of risk. When governments inject trillions of dollars into the system, they dilute the value of every dollar already in circulation. That means your money sitting idle is buying you less and less with each passing year. And once I understood that, everything clicked. Investing isn't just a strategy to grow wealth, it's a necessity to preserve it. I didn't start with a lot of money. That first $500 into Bitcoin was a stretch for me at the time. I remember thinking, what's the point? This will take forever to make a difference. But I stuck with it. Whenever I had some spare cash, even if it was just a couple $100, I'd add to my portfolio. I didn't always get the timing right, but that didn't matter. I was learning to build the habit of investing. That's how I discovered the power of dollar cost averaging. Instead of waiting for the perfect time to invest, I just added a little whenever I could. I didn't try to time the market, I focused on time in the market. Those small steps, investing consistently, even in small amounts, added up over time. It wasn't a get-rich-quick story. It was a slow, steady climb. That's the reality of investing. It's not always exciting, and it doesn't feel like you're winning every day. But consistency matters. Every small investment was a seed that eventually grew into something meaningful. If you're thinking you don't have enough money to start, let me tell you, you don't need a huge amount to begin. You just need to begin. Small steps taken consistently over time can become something big, and that's exactly how I got here. Instead of spending my nights out, I found myself staying in and devouring anything I could find about investing. I would listen to podcasts while driving, read articles between meetings, and scroll through forums late at night, searching for insights. I found mentors in pages. One of the first books I read was Rich Dad, Poor Dad by Robert Kiyosaki. It drilled into me the concept that rich people work to learn, while poor people work for money. That line hit hard because it made me realize I'd been stuck in a cycle, always working for money instead of making money work for me. Around the same time, I discovered Dan Lok, an influencer who taught me that the most valuable thing in life is time. If you have money, you can buy time. You can work less and spend more time with your family on your passions and doing the things you love. That changed how I viewed wealth. It wasn't about owning flashy cars or watches. It was about freedom, the freedom to live life on your own terms. Once I understood that, I became obsessed. I devoured books on investing, The Intelligent Investor, One Up on Wall Street, The Little Book of Common Sense Investing, and so many others. I followed markets, tracked trades, and began to shift my thinking from income to asset building. I truly believe that the more you learn, the more you earn. That mindset changed everything for me. Reading became my edge. Every book gave me a new lens through which to view risk, strategy, and opportunity. It's no coincidence that some of the most successful investors and entrepreneurs are lifelong learners. Leaders are readers, and reading is what gave me the confidence to take calculated risks and the clarity to stay the course. The thrill I once got from making sales I now found in watching my portfolio compound. It was a whole new game, and I was hooked. Of course, it wasn't all smooth sailing. I made plenty of mistakes along the way. I chased hype stocks and sold too quickly when prices dipped. I let fear dictate my moves during market downturns, only to watch those same investments rebound later on. I took on too much risk at times. I overtraded. I tried to predict the market. Every mistake taught me something, not just about the markets, but about myself. That obsession turned into discipline. I studied relentlessly, tested ideas, made mistakes, and learned from them. I realized that the key wasn't just picking winners, but managing risk, staying invested, and thinking long-term. Eventually, I earned my master's degree in finance, graduating with excellence. I wanted to back up my passion with real knowledge, to prove to myself and others that this wasn't just a hobby, it was a lifelong commitment. The best investment you can make is in yourself. Warren Buffett. Fast forward to today. Through the ups and downs of the markets, I've built a 7-figure portfolio. Not through luck, hype, or timing every move perfectly, but through a clear, repeatable strategy grounded in long-term thinking and smart risk management. And I'm not the only one it's helped. A close friend who applied my strategy built a 5-figure portfolio starting with just $1,000 over a few years. He told me, "The only thing I regret is not starting sooner." That stuck with me. Making money is easy. Taking the first step is hard. I wrote this book because I know what it's like to feel lost at the start. I know how overwhelming the market can feel when you're bombarded with opinions and headlines. I've been through the noise, the hype cycles, the panic selling, the constant urge to do something every time markets move. I've been that person refreshing charts at midnight, worrying that every dip meant disaster. I want to share the path that worked for me, not as a promise of overnight success, but as a guide that, if followed consistently, can lead to financial freedom. Wealth to me is financial freedom, not just getting rich. It's having time to spend with my family and on the things that bring me joy. It's waking up without the anxiety of bills or the pressure of working a job I don't love just to make ends meet. It's about living on your terms, doing what you love, and having the freedom to walk away from anything that no longer serves you. I want others to know that it's possible, no matter where you're starting from. Maybe you're where I was, making good money but not building wealth. Or maybe you're just getting started and want to skip the trial and error phase. This book isn't written from a pedestal. It's written from experience. From someone who made mistakes, learned lessons, and kept going. You don't need to be born rich to get rich. You just need the right mindset and a system that works over time. That's what this book offers. A strategy you can use, a mindset you can adopt, and a system that works if you stay the course. This book isn't a promise of overnight success. It's a blueprint for sustainable wealth building, drawn from years of personal experience, backed by education, and proven by results. It's part of my mission to make professional-level investing accessible to anyone who's willing to think long-term and stay committed. Whether you're new to investing or looking for a smarter way to grow your wealth, I hope this book gives you clarity, confidence, and maybe even a bit of inspiration. If you're reading this, it means you're ready. Ready to stop playing small, ready to stop surviving, ready to start building real wealth. Let's begin. Chapter 2, From Grind to Growth. How my mindset evolved from chasing quick wins to building a sustainable strategy. In 2017, I bought Bitcoin. I was drawn in by the buzz, the potential, and the idea that this digital asset could rewrite the financial system. But when it dropped 30% in a few days, I panicked and sold. I told myself I'd buy back lower, but instead, I watched it 5x, then 10x without me. Eventually, I did get back in, but the damage was done, not just to my capital, but to my psychology. That was the day I realized something crucial. The biggest cost in investing isn't just losses, it's missing out because you didn't trust your thesis. That early misstep rocked my confidence. It was more than just a financial setback. It was a mental one. I remember the frustration, the self-doubt, the endless what-ifs. I wondered why I hadn't held on, why I let my emotions override my analysis, why I let fear drive my decision-making. Looking back, that early failure was one of the best things that could have happened to me. It lit a fire, a drive to understand markets deeply and never again let panic dictate my actions. I started to realize that investing isn't just about charts and numbers. It is about psychology. Could I handle the stress? Could I hold my ground when everything in my gut told me to run? These were questions I had never considered before. That's when I started journaling every trade I made. I'd write down why I was entering, what my plan was, and how I'd feel if things went south. It was raw, honest, and sometimes uncomfortable. But it helped me spot patterns, not just in the markets, but in myself. I also started talking to other traders and investors online. I joined forums, read posts, and share my thoughts. It was humbling to realize how many others had similar experiences, buying too high, selling too low, doubting their strategy. There's a certain camaraderie that comes from sharing your mistakes, and it made me realize that even the best investors started out feeling lost. That gave me the courage to keep going, to refine my process, and to understand that everyone's journey is a work in progress. From that point forward, I became obsessed with understanding markets, cycles, and investor behavior. I didn't want to be the person who sold too early ever again. That mistake taught me that conviction matters more than timing. In my early days, I came from a technical analysis background. I'd study charts for hours, marking support zones, resistance levels, moving averages, RSI, MACD, you name it. And to be fair, it worked well at times, especially for timing entries and exits in high volatility environments. One early example was trading small cap tech stocks around earnings season. The chart setups were clean, the volatility high, and the payoff potential decent. I'd spend hours at night marking up my charts and plotting my plan, but too often I'd get whipsawed because I didn't understand the fundamental drivers behind the moves. I'd see a beautiful breakout, jump in, and watch it fade as quickly as it appeared. That experience taught me that technicals are only half the equation. I'd wake up the next day and see a news headline that explained the drop. Suddenly I realized the chart had given me an entry, but the narrative had pulled the rug out from under me. I felt like I was playing half-blind. That's when it clicked that there had to be more to investing than lines on a screen. As I matured, I realized charts alone weren't enough. If the fundamentals and the narrative don't align, even the most beautiful breakout can fail. That's when I began to study macro, global liquidity cycles, interest rates, central bank policies, and how they affect risk assets. I started to see how macro tailwinds, like quantitative easing, created environments where risk-on trades thrived. I learned that liquidity drives everything. When the Fed is printing money, risk assets soar. When the taps tighten, everything changes. I remember one time in 2020 when the market was crashing during COVID fears. I watched my charts light up red. My technicals screamed oversold, but my gut was telling me to get out. That's when I pulled up the Fed's balance sheet and saw trillions of dollars being pumped into the system. That gave me the confidence to hold and even buy more. That experience taught me that sometimes the market's worst days are actually the best opportunities. It taught me that liquidity is the lifeblood of markets, and that understanding the macro picture could give me the edge to stay calm while others panicked. The combination of technicals and macro gave me a sharper edge. I could see not just what was happening, but why it was happening. I stopped getting blindsided by big moves that made no sense on the chart alone. But the real breakthrough came when I started thinking in narratives. It hit me when I noticed certain stocks running well ahead of their fundamentals. Tesla, Nvidia, Palantir. These companies weren't loved because of spreadsheets. They were loved because of stories. Tesla wasn't just an EV maker. It was saving the planet. Nvidia wasn't just a chip stock. It was powering the AI revolution. Palantir wasn't just software. It was the backbone of national security. Narratives drive flows, and in modern markets, flows matter more than fundamentals, at least in the short to medium term. I saw that investors weren't just buying numbers. They were buying visions of the future. And the bigger and bolder the vision, the more powerful the narrative. One pivotal moment came during the early stages of the AI boom. While some investors waited for clean cash flow models, I saw the wave building. I positioned early, not because of trailing numbers, but because I understood where the puck was going. That insight shaped how I now build positions. I use technicals for timing. I use macro to assess the risk environment. But I rely on narratives to identify where the real upside lives. Over time, I developed tools to manage risk more strategically. I stopped worrying about being right all the time and started focusing on positioning correctly when I was. I started to accept that I wouldn't always get the exact bottom or top, but that didn't matter. What mattered was catching the meat of the move, managing risk, and letting winners run. That's when I discovered the Sortino ratio and Jensen's alpha, risk-adjusted metrics that reflect smart volatility, not just volatility. Warren Buffett say, risk comes from not knowing what you are doing. I realize that high conviction trades come with high variance. But if your downside is controlled and your upside is exponential, that's the game worth playing. Eventually, I earned my master's in finance, graduating with excellence. Not just to gain credentials, but because I wanted to understand the mechanics behind the market at a deeper level. I wanted to back up my passion with real knowledge, to connect the dots between the stories, the charts, and the fundamentals. Now my framework is a fusion of everything I've learned, a blend of macro cycles, technical confirmation, narrative strength, risk metrics, personal conviction. This is the evolution I've lived, and what I hope this book helps accelerate for you. If you're just starting out, don't worry about having the perfect system. Focus on learning, reflect on your losses, track your wins, build your conviction one step at a time, and most importantly, stay in the game. Because the longer you stay in, the more patterns you see. And once you see them, you never look at markets the same way again. In hindsight, I can also see how my background as a business owner shaped the way I approached investing. When I ran juice bars and cafes, I was in control. Every problem had a solution. Hire better staff, negotiate with suppliers, launch a promo. But in markets, I had to give up control. I couldn't force a trade to succeed or make a stock move just because I wanted it to. That was tough. It required a shift in mindset, from controlling everything to accepting uncertainty and managing risk. I remember one of my biggest business-minded mistakes, treating the market like a business deal. I tried to force a position to work just because I did the work, like how I expected results in business if I put in the effort. But markets don't reward effort. They reward positioning and patience. I held a small cap stock way too long, refusing to cut my loss because I had committed. It dropped 60%. That loss taught me one of my core principles. Don't marry your positions. What helped me evolve was constantly educating myself. Beyond the degree, I devoured material that taught me how to think. Books like Principles by Ray Dalio and The Psychology of Money by Morgan Housel. I learned that education compounds like capital. The more context I had, the less reactive I became. Smart money isn't just about having capital, it's about having context. I also kept journaling. Every win, every loss, every emotional reaction. I started rating my trades, not just by outcome, but by process. One of my most revealing insights was realizing I made more money on trades I felt bored about. Why? Because those were the calm, logical setups, not emotional, not impulsive. Without journaling, I never would have seen that pattern. Conviction, I've learned, isn't just believing in a stock, it's believing in your process. For me, conviction now means I understand the macro backdrop. The narrative makes sense and has legs. Technicals support my thesis. I've sized appropriately. It means I can sleep at night even if the position dips. If I could go back and tell myself one thing in 2017, it would be this. Slow down. Learn the rules of the game. Don't chase, don't panic, and don't try to skip steps. Compounding only works if you give it time, and if you're around long enough to benefit from it. That's what I hope you will take from this chapter. The journey to becoming an investor isn't about changing who you are. It's about refining your instincts and letting your money work smarter than you ever could alone. Final thoughts. Growth doesn't happen all at once. It happens in layers. One hard lesson at a time, one insight at a time, one mistake followed by reflection. My journey from hype chasing to conviction building wasn't overnight. It was painful, messy, and deeply personal. But it was necessary. The shift from grind to growth wasn't just about changing how I invested. It was about changing how I thought. It meant trading control for clarity, trading fear for discipline, and most importantly, trading speed for sustainability. So freedom keys. Mistakes aren't failures, they're tuition. Every early loss was a lesson that refined my edge. Emotions are the first enemy of consistency. The sooner you learn to manage them, the faster you evolve. Conviction outlasts panic. A strong thesis keeps you grounded when charts get noisy. Technicals are tools, not a compass. The real direction comes from macro and narrative alignment. Growth means letting go of control. You don't need to predict the market, you need to position within it. One call to action. Take 10 minutes and reflect on a mistake you've made in investing, one that still lingers. Write down what triggered it, what you felt, and what it taught you. Then flip the script. What would you do differently now with the mindset you're building? In the next chapter, I'll show you how I started developing my edge and the tools I built to invest with clarity, confidence, and structure. Chapter 3, Finding My Edge. How I developed a research process that gave me confidence in my decisions. A strong investment philosophy is the foundation, but without the right tools to guide your decisions, even the best ideas can fall apart. Let me take you back to early 2022. Inflation was surging, the Fed was raising rates, and fear dominated the headlines. I opened my portfolio and saw a sea of red. My instinct said, sell everything, but I paused. I pulled up my liquidity charts, checked my macro filters, and reminded myself of my conviction in the underlying themes I was holding. I didn't sell, I doubled down on a few core positions. Within weeks, the rebound began, and that decision became one of my most profitable. That moment cemented something for me. Without a system, without tools to ground your decisions, even the most promising strategies can crumble under pressure. I've made enough mistakes to know that discipline, conviction, and risk management aren't optional extras. They're essential. Over the years, I've developed what I call my conviction framework, a toolkit that helps me stay objective, filter out noise, and focus on what really matters: risk-adjusted performance, long-term positioning, and strategic allocation. These tools didn't come from textbooks alone. They were forged in the real-world battles of market volatility, panic sell-offs, and moments when conviction was the only thing that kept me in the game. Pro tip: tools don't replace discipline, they amplify it. Here are the tools and metrics I rely on to navigate the markets and build a portfolio that delivers consistent outperformance. Sortino ratio: rewarding the right kind of risk. The Sortino ratio is like a smart risk filter. Instead of punishing every market move, both up and down, it only looks at the losses that hurt your portfolio. Imagine you're driving a car. Bumps on the road, volatility, might make the ride a bit shaky, but the real risk is the potholes, losses that can blow a tire. The Sortino ratio focuses on how well your investments avoid those potholes while still moving you forward. A higher Sortino ratio means you're getting good returns without too many nasty surprises. It's one of the ways I measure the quality of my strategy, how well it rewards the risks worth taking. When I first discovered this metric, it was like a light bulb went on. I realized that not all volatility is created equal. The ups and downs that come with a market trend can be a sign of opportunity, not risk. But sudden drops, the kind that make you question everything, that's the real risk to manage. As of the time of writing, my Sortino ratio is 1.77, as tracked on my eToro fact sheet. To put that into perspective, most hedge funds struggle to hit 1.2. Anything above 1.5 is considered elite. This isn't just good risk management, it's smart volatility. I don't try to avoid market swings, I position myself to benefit from the right ones. The key is to let the upside run while managing the downside with discipline and patience. Macro and liquidity filters. Every trade I make is viewed through a macro lens. Before I buy any stock, I ask, is liquidity expanding or contracting? Is the Fed hawkish or dovish? Are we in a trend-driven, narrative-fueled cycle, or are fundamentals taking the lead? These aren't just academic questions. I learned the hard way that ignoring macro is like planning a beach day without checking the tide. You might have the best umbrella, snacks, and playlists, but if the waves are crashing in, your perfect setup doesn't stand a chance. A key signal I watch is the U.S. liquidity cycle, especially in relation to how the government manages its debt. The U.S. has trillions in debt coming due over the next few years, and much of it needs to be refinanced at higher rates. This creates a dilemma: either let yields rise, tightening conditions, or step in to stabilize markets. Historically, the Fed leans toward support. This reinforces a core belief in my strategy. When liquidity returns, markets rise. Understanding when and how that liquidity comes back is one of the biggest edges in modern investing. I've seen it time and time again, from the post-GFC recovery to the COVID crash and beyond. Liquidity drives markets. Concentration with conviction. I believe in owning fewer positions, but knowing them deeply. Early in my investing journey, I'd spread myself too thin, thinking that owning more stocks meant less risk. But over time, I realized that too much diversification can actually dilute your returns and your conviction. Warren Buffett once said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." I couldn't agree more. That doesn't mean I ignore risk or correlation. Far from it. I actively manage my portfolio to ensure I'm not overexposed to a single sector or theme, and I rebalance quarterly to prevent concentration drift. But I don't spread capital thin just for the sake of looking diversified. Some of my core holdings, like Tesla, Palantir, and Nvidia, are grounded in this conviction. They aren't trades. They're long-term thematic bets backed by years of research and a deep understanding of where the world is heading. True conviction means being selective, decisive, and patient. Not owning everything, but owning the right things. It's about building positions that you can hold through the inevitable volatility because you know the story, the fundamentals, and the macro backdrop. Tools and platforms. I trust. One of the biggest lessons I've learned is that the right tools can make or break your investing process. I've tested dozens of platforms and data sources over the years, but I always come back to the ones that help me cut through the noise and focus on what matters. TipRanks. This is my main source for reliable, real-time data on stocks and analysts' opinions. I have a premium subscription, which gives me access to consensus ratings, price targets, insider trades, and more. It's like having a team of analysts on call, but without the hype. TradingView. For technical analysis, this is my home base. I use it to mark up charts, spot support and resistance zones, and identify patterns that might affect my entry and exit points. I also have a premium membership here, which means I get real-time data and advanced features that help me fine-tune my strategy. FRED, Federal Reserve Economic Data. When it comes to understanding the bigger picture, FRED is my go-to. It gives me a direct look at macroeconomic indicators like interest rates, liquidity trends, and debt levels. All the things that move markets over time. Well, FinViz. This is my favorite for screening stocks, finding trends, and visualizing sector performance. It helps me narrow down the universe of potential trades to the ones that fit my strategy best, staying away from the media. One thing I've learned is that the media can be a distraction, not a guide. Headlines are often written to grab attention, not to inform. I'd rather spend my time on platforms that give me raw data and real insights than get caught up in the day-to-day noise. Over the years, these tools have helped me refine my process, stay objective, and build the kind of conviction that withstands market volatility. But they didn't come without trial and error. I remember once buying into a breakout trade that checked every box technically. The chart was clean, volume was rising, and it had all the makings of a winner. What I ignored, a major Fed speech that week. The market sold off hard on hawkish comments and my trade got stopped out. That was the day I learned price action without macro awareness is like navigating half-blind. Each one of these tools has helped me course correct, see clearer, and build a system I trust. They're not the secret to success, but they are the foundation that makes success possible. Ask yourself, what metrics do you use to judge your trades? Are you tracking your own Sortino or Alpha? Final thoughts. I didn't stumble into clarity. I built it through trial, reflection, and relentless curiosity. The edge I have today didn't come from one big breakthrough. It came from stacking small insights, refining my tools, and committing to a process that could hold up under pressure. Your edge doesn't have to look like mine, but you need something that keeps you grounded when everything around you is shaking. Because without structure, emotion takes over. And when emotion leads, conviction disappears. Freedom keys. Tools don't replace discipline, they amplify it. Risk-adjusted metrics like Sortino ratio and Jensen's alpha keep your strategy honest. Macro context matters more than most people realize. Liquidity drives markets. Concentration isn't risky if it's backed by real conviction and research. A reliable framework reduces panic and strengthens execution under stress. Call to action. Take 15 minutes and audit your current strategy. What tools do you use to manage risk, evaluate performance, or filter noise? If you don't have a process yet, start designing one even if it's simple. Your future self will thank you. In the next chapter, I'll break down how I ride sector rotations and macro cycles, and how understanding the bigger picture turned me from a stock picker into a strategist. Chapter 4. Riding the waves. Using macro and narrative cycles to build wealth. I don't chase headlines, I don't follow the crowd, but I do pay close attention to where the world is going, and I align my capital with those trajectories. The goal isn't just to find good companies, it's to own the right companies at the right time, in the right sectors, riding the right wave. That's where sector rotation and megatrend investing come in. Early in my investing journey, I used to focus on individual stock stories in isolation. I'd get excited about a company's product, management team, or earnings growth and buy in, only to watch the stock get tossed around by broader market cycles I didn't fully understand. That's when I realized even the best stock can get pulled down if it's in the wrong sector at the wrong time. I learned that markets move in cycles, driven by policy, liquidity, sentiment, and growth expectations. Different sectors lead at different times, tech in one cycle, energy in another, then maybe healthcare or industrials next. Understanding these cycles became a game changer for me. Benjamin Graham says, in the short run, the market is a voting machine. In the long run, it is a weighing machine. Follow the flows, not the noise. Most retail investors miss these shifts because they're focused on the headlines, not the flows. I made that mistake too, early on, buying into the latest hot stock while ignoring the bigger picture. But institutional capital rotates with purpose. And if you know how to track it, you can position yourself early. Now, before I buy any stock, I ask myself, where's the money flowing? What's driving that flow? Policy, liquidity, or sentiment? Is this a short-term reaction or is it part of a larger cycle? I pay attention to macro triggers like Fed policy shifts, rate cuts, QE, forward guidance, inflation trends and bond yields, fiscal spending themes, infrastructure, green energy, AI, defense budgets, earnings trends across sectors. When I see signs that a rotation is building and it aligns with a long-term megatrend, I move. One example came during the COVID crash in early 2020. While headlines screamed panic, I watched the Fed's balance sheet balloon as trillions in liquidity flooded the system. I knew that kind of capital would eventually find its way into risk assets. That's when I rotated into tech and growth stock 7 while the media was forecasting a prolonged recession. That move paid off in spades and taught me that liquidity leads narratives. Fast forward to late 2022. This time, the fear was inflation, rate hikes, and a looming recession. But instead of panicking, I looked for signs of a shift in policy tone, liquidity signals, and forward guidance. When I saw early signs of easing, I leaned back into my highest conviction AI and tech plays like Palantir and NVIDIA. That early positioning gave me a head start before the sentiment shifted. It was a reminder that staying ahead of the cycle requires both data and discipline. Sure, investing in megatrends, not moments. Some opportunities are cyclical, others are structural. I focus on the structural ones, the megatrends that will define the next 5 to 10 years of innovation, productivity, and capital allocation. These are the big waves you can ride through volatility, the trends that reshape industries, not just headlines. Right now, some of the biggest megatrends I'm positioned in include artificial intelligence, NVIDIA, Palantir, electric and autonomous vehicles, Tesla, robotics and automation, Tesla, decentralized infrastructure via Coinbase and Ethereum exposure, digital dominance, Google, Meta, Amazon. These aren't flavor-of-the-month trades. They're multi-decade transformations, and I want to own the leaders early and ride them through volatility, not in and out with every earnings report. When people say a stock is overvalued, I ask, compared to what? If a company is building the future, the old valuation models often fail to capture the full picture. Amazon looked expensive at every stage of its growth until it wasn't. Early on, I'd get spooked by the PE ratios or the talking heads on TV. I'd sell too soon, only to watch the stock double or triple while I sat on the sidelines. Now I think differently. I focus on business models, moats, and the company's ability to dominate a megatrend. When to rotate, when to hold. I'm not rotating every week. This isn't day trading, but I also don't hold blindly. If a stock I hold becomes misaligned with the macro backdrop, loses its competitive edge, or becomes crowded at the end of a hype cycle, I'll reallocate, not out of fear, but out of discipline. For example, if liquidity tightens and the market favors value or defensive names, I may reduce exposure to high beta growth temporarily and look for balance. But once the environment shifts again, I'm ready to rotate back into risk-on names with tailwinds behind them. Girl, it's not about reacting emotionally. It's about adapting intelligently. One time I got too attached to a tech stock during a cycle when defensive names were leading. I held on out of stubbornness and watched gains evaporate. That was a painful but valuable lesson. Your favorite stock is still a stock, and it's not immune to the broader environment. Now I focus on aligning my positions with the macro cycle and the bigger narrative. It's about stacking probabilities in your favor. The edge, thinking forward. The biggest edge any investor can have is perspective. Most of the market is stuck in the present, trading headlines, reacting to data, swinging with sentiment. I try to stay anchored in the future. What industries will dominate in 2030? What will AI, automation, and energy disruption look like? Which companies are building the infrastructure for that world today? Sector rotation is how I tactically move through cycles. Megatrend investing is how I stay anchored to the bigger vision. Together, they allow me to capture upside, manage risk, and build wealth through evolving market conditions. The MNR method: macro, narrative, rotation. To simplify how I apply this philosophy, I've built a simple framework I call the MNR method. 1. Macro: is liquidity expanding or contracting? What's the Fed doing? Where are bond yields and inflation headed? 2. Narrative: is there a compelling story behind the sector or company? Are investors excited about its vision of the future? 3. Rotation: are we seeing a shift in capital flows? Which sectors are gaining strength and which are fading? One trend I'm watching: biotech AI. Even though I haven't positioned heavily into it yet, I'm keeping a close eye on the intersection of AI and biotechnology. Companies using artificial intelligence to accelerate drug discovery or precision medicine could spark the next wave of innovation. I'm tracking names in this space and watching for a clear macro and narrative alignment. When the signal comes, I'll be ready. Try this. Apply the framework to your portfolio. Ask yourself, are your current holdings aligned with the future or stuck in the past? Do they reflect strong narratives that investors believe in? Are they in sectors gaining momentum or ones losing steam? Don't just hold because it's familiar. Hold because it's forward-facing. Quick checklist: how to think like a macro narrative investor. Watch liquidity cycles. The Fed's actions can move entire markets. Look for fiscal spending trends that align with your investments. Align sector moves with mega trends that will shape the next 5–10 years. Don't let headlines push you around. Focus on the data and flows. When things get noisy, zoom out and ask, where is the world going? From theory to practice. This approach didn't come overnight. It was forged through mistakes, like getting shaken out of winners too early or holding on to losers too long because I didn't understand the macro context. I remember buying into a tech stock in 2019, only to watch it drop 30% when trade war headlines hit. I panicked and sold, but if I'd stayed focused on the big trend, I could have ridden that stock to triple-digit gains. Every mistake was a lesson. Every rotation taught me something about timing, conviction, and discipline. Over time, I learned that success doesn't come from predicting every move. It comes from positioning your portfolio in a way that lets you capture the upside when the tide turns in your favor, and managing risk when it doesn't. That's what this book is about, helping you see the bigger picture, stay grounded in the trends that matter, and avoid getting swept away by the noise. Final thoughts. Riding the waves isn't about trying to predict every swell, it's about positioning yourself with purpose. Markets rotate, narratives evolve, liquidity shifts, but wealth isn't built by reacting to noise, it's built by aligning your capital with long-term structural trends and staying invested through the chop. This chapter wasn't about theory, it was about understanding the deeper current that moves the market: macro cycles, investor sentiment, and secular transformation. When you can zoom out far enough to see the wave forming and position early with conviction, that's when investing stops feeling like a gamble and starts becoming a strategy. Because in this game, timing matters, but alignment matters more. Freedom keys: macro moves first. Liquidity cycles and Fed policy set the tone for sector leadership. Narratives attract capital. Investors follow stories before they follow fundamentals. Megatrends are your tailwind. Positioning in multi-decade shifts like AI, EVs, and digital infrastructure keeps you anchored through volatility. Rotation is tactical, not emotional. Move when flows and narratives shift, not when fear takes over. Know when to hold, know when to adapt. Strong stocks still need the right environment to thrive. Follow the flow, ignore the noise. Capital doesn't chase headlines, it chases asymmetric opportunity. Call to action. Take a moment now to think about the trends you believe in. What industries excite you most? Which companies are building the future you want to be a part of? Start exploring how you can align your capital with those opportunities and position yourself for the next wave of growth. In the next chapter, I'll dive into the conviction behind my core holdings and how adaptability helps me navigate an ever-changing market. Chapter 5. Conviction and Adaptability. Balancing strong beliefs with the need to rotate into new opportunities. I don't invest in tickers. I invest in companies building the future. Every core position in my portfolio represents a high conviction belief in where the world is heading, supported by macro tailwinds, secular trends, and strong narratives. These aren't trades. They're strategic placements in the foundations of tomorrow's economy. When I first started investing, I used to jump from one stock to another, always chasing the next hot tip or breakout pattern. At the time, I thought I was being agile and opportunistic. In reality, I was just being reactive. I'd catch a wave but fall off before the real ride began. The truth? Most of my best investments came from holding on, not hopping around. Peter Lynch say, "Know what you own and know why you own it." That quote became a cornerstone of my philosophy. These days, when I build a position, I want to know everything about it: the company's mission, its moat, its leadership, the macro trend behind it, and the risks it faces. I don't just buy based on numbers. I buy based on conviction. And when that conviction is high, I size accordingly. But conviction without flexibility is a trap. The market is always changing. Narratives shift, interest rates rise and fall, sentiment swings like a pendulum. If you marry a position just because it once made sense, you can get blindsided. That's where adaptability comes in. I've learned to hold strong beliefs, but hold them loosely enough to rotate when the data changes. This chapter is about striking that balance, having the courage to bet big on your vision, but the wisdom to know when it's time to pivot. Let me show you how conviction and adaptability played out in 3 of my real-world positions, each one rooted in a strong narrative and macro view, but managed with discipline. Tesla, more than just a car company. Tesla is often misunderstood. To the average investor, it's an electric vehicle manufacturer. But to those paying closer attention, it's a software company, an energy company, and possibly the most ambitious AI company on the planet. What drew me to Tesla wasn't just the cars. It was the scale of Elon Musk's vision. Full self-driving, autonomous robotaxis, energy storage, solar, AI training chips, humanoid robots. This is a company that doesn't play by Wall Street's short-term rules. It builds for the next decade. I first invested in Tesla when most people were laughing at it. I remember the headlines calling it a bubble, mocking its production delays, and questioning Musk's sanity. But I read every earnings report. I watched every shareholder meeting. I listened to Musk outline a mission that resonated far beyond profit margins. That's when I realized Tesla wasn't just innovating. It was re-architecting the infrastructure of mobility and energy. Of course, the ride wasn't smooth. I've held Tesla through gut-wrenching drawdowns, regulatory battles, and moments when sentiment flipped on a dime. But each time I asked myself the same questions. Is the vision still intact? Are the fundamentals still improving? Is the narrative broken or just misunderstood? Every time the answers were yes, yes, and no, I held or even added. That's conviction. During the 2022 tech sell-off, I had a copier reach out, worried about Tesla's brutal 40% drawdown. He was ready to exit, but I reminded him the mission hadn't changed. Production was scaling. The energy segment was accelerating. Sentiment was panicking, not the fundamentals. He held on. A year later, that same copier messaged me with a simple line. "Thanks for keeping me in. That position alone changed my portfolio." But adaptability also plays a role. When Tesla became too large a portion of my portfolio due to its explosive growth, I trimmed some of my position, not because I lost faith, but to manage risk. Conviction should drive your entries. Adaptability should guide your rebalancing. Palantir, owning the backbone of decision-making. Palantir is another core holding and another misunderstood company. Most people still think of it as a mysterious defense contractor, but the reality is far more powerful. Palantir builds the operating system for the modern enterprise, a platform where data, decision-making, and execution merge. In a world drowning in data, the real value comes from turning complexity into clarity. That's Palantir's superpower. Whether it's fighting pandemics, optimizing supply chains, or powering battlefield decisions, Palantir is shaping how organizations think and act. What attracted me wasn't just their product, it was their philosophy. CEO Alex Karp openly resists the quarterly rat race. He talks about building something that lasts 20 years, not just crushing the next earnings report. That long-term mindset aligns with mine. Palantir also taps into one of the biggest mega trends I believe in, the convergence of AI and decision intelligence. As AI grows, it won't be enough to just make predictions. Companies will need platforms that connect those predictions to real-world action with traceability, ethics, and control. Palantir is positioned at that intersection. Of course, owning PLTR hasn't always been easy. It's been volatile. It's had haters. It's moved sideways for long periods. But the more I studied the company, the more I understood its edge. When you combine government-grade security with commercial-grade agility and wrap it in a scalable platform, you're holding the future. That's why I didn't sell during the noise. I sized it as a core conviction play, and I've stayed with it. Against NVIDIA, the infrastructure of the AI revolution. If AI is the future, NVIDIA is the shovel maker. This company doesn't just sell chips. It powers the very infrastructure of artificial intelligence. From data centers to autonomous driving, from LLM training to inference at the edge. NVIDIA was once seen as a gaming company. Now it's the lifeblood of every startup and enterprise building intelligent systems. Every time you hear about ChatGPT, self-driving cars, or smart robotics, NVIDIA is behind the scenes. I added NVDA early in the AI cycle, not because I knew exactly how fast the boom would accelerate, but because I could see the signs. The GPU wars were heating up, demand was exploding, and NVIDIA was years ahead in both hardware and software. Their CUDA ecosystem created a moat that's hard to replicate, and that's before you even factor in their moves into networking, cloud platforms, and AI as a service. Adaptability played a huge role here. I didn't blindly hold my position during frothy peaks. I trimmed when sentiment became euphoric and added again on weakness. That's how I ride the waves, with discipline, not emotion. The power of rotation and reevaluation. Conviction isn't static. It's a living, breathing thing. You can believe in a company and still reduce exposure when conditions change. I'll give you an example. I once held a high-growth SaaS name that was flying in the low-rate environment of 2021. But when inflation surged and rates began climbing, the macro backdrop changed. I revisited the thesis and realized that the valuation made less sense in a tightening environment. The narrative cracked and I rotated out. Did I still believe in the company's tech? Sure, but conviction doesn't mean ignoring the environment. Adaptability means recognizing when the risk-reward shifts and acting. Too many investors get stuck in thesis paralysis. They fall in love with a stock and ignore new information. I've been there. It's painful. But every time I've cut a position that no longer fit, my portfolio thanked me later. And I remember being deeply invested in a green energy company that fit my long-term view. The story made sense. The trend was real. But management fumbled execution, delays piled up, and capital dried up. I held on too long. My conviction blinded me to the red flags. It was one of my most painful lessons, and one of the most important. Conviction earns you the right to hold, but adaptability earns you the right to survive. Neither sizing based on conviction. Here's a rule I live by. If you wouldn't double down on a stock during a drawdown, it's not a core position. That mindset forces me to think deeper before sizing up. Every large position in my portfolio has passed this test. If the stock dropped 20%, would I buy more or panic? If it's the latter, I probably sized too big or didn't believe in it enough to begin with. Conviction isn't about being right. It's about being prepared to stay in the game and even press your edge when the market tries to shake you out. Build your conviction scorecard. If you want to build real conviction, ask yourself, can I explain what this company does in 2 sentences? What macro trend supports its growth? What would make me sell this stock? If it were to drop 30%, would I add or panic? Final thoughts. I often revisit how similar setups played out historically. Seeing how growth stocks rebounded after past rate hike cycles or how tech leaders recovered post-sell-off helps me stay grounded. As the saying goes, history doesn't repeat itself, but it often rhymes. Backtesting historical patterns isn't about prediction, it's about context. It strengthens conviction when the present feels uncertain. Whether it's Tesla, Palantir, NVIDIA, or a new emerging name, I always ask, does this fit my macro view? Is the story still strong? Am I prepared to ride the waves ahead? The magic happens when you learn to blend both. When you build positions that you believe in so deeply that you can sleep through volatility while staying open-minded enough to evolve when the story changes. That's how wealth is built, not by chasing tickers, but by investing in visions you understand, believe in, and are willing to defend through the storms. Freedom keys. Conviction earns your position. Do the work. Understand the business, the macro, and the narrative before sizing up. Adaptability protects your capital. When conditions change, don't freeze pivot with discipline. Strong beliefs, loosely held. Stay open to new information even when you're deep in a trade. Conviction isn't ego, it's process, research, and the ability to sleep at night during a drawdown. So don't marry your positions. Love the thesis, not the ticker. When the story breaks, it's okay to move on. Size for resilience. If you can't buy more during a 30% drop, it's not a core position. It's a risk. Call to action. Think about your current holdings. Which ones do you truly understand and which ones are just guesses? Choose one position and do a deep dive review. The macro setup, the narrative strength, and your conviction level. If the story no longer holds up, have the courage to adapt. If it does hold with strength. In the next chapter, I'll show you how I turn conviction into structure, how I size my positions, manage risk, and protect my portfolio without diluting upside. Chapter 6. Sizing matters. Managing position sizes and risk to protect and grow my portfolio. Position sizing is where theory meets execution. I learned this lesson the hard way early in my journey. Like many new investors, I was focused on finding the perfect stock, the next big thing that would skyrocket overnight. I remember buying a small cap stock that I was excited about. The story was compelling, the sector was hot, and I couldn't wait to see it soar. But I only put in a small allocation thinking I was being cautious. A year later, it had tripled. But because my position was tiny, the impact on my overall portfolio was negligible. That moment stuck with me. It was the wake-up call that even when your thesis is spot on, if your sizing is off, the payoff won't move the needle. It taught me that position sizing isn't just a technical detail. It's the force multiplier of your entire strategy. Why sizing matters more than stock picking. Early on, I used to obsess over stock selection, looking for the perfect pick. Over time, I realized that even a great pick, if sized poorly, can underdeliver. Meanwhile, a well-sized, high-conviction idea can drive performance, even with short-term volatility. The market doesn't reward being right. It rewards being right enough with size and discipline. Core versus satellite framework. I structure my portfolio around two buckets. Core holdings. These are my highest conviction, long-term bets. Think Tesla, Palantir, NVIDIA, names I believe will lead their sectors for the next 5-10 years. They get larger allocations, and I'm willing to hold through volatility because I've done the homework. Satellite positions. These are smaller, more tactical ideas. Earlier stage companies, more volatile sectors, or opportunistic trades. I size these smaller to limit risk, but I'm always tracking whether they should be upgraded to core over time. This framework helps me stay organized and intentional. Not everything deserves equal weight, and not every new idea needs to be a hero trade. Conviction scales. Allocation. The size of a position reflects my conviction, but also my tolerance for volatility. For example, a high-growth name with strong fundamentals and macro tailwinds might get a 10-15% allocation. A speculative, small-cap, or early-stage disruptor might get 2-5%, even if I love the story. Conviction isn't just belief, it's belief with supporting data. That includes macro alignment, valuation discipline, and a clear long-term thesis. When I size up aggressively, sometimes I size up based on event-driven opportunities. If a high-conviction company has an upcoming catalyst, like Tesla's anticipated robotaxi launch, I may increase exposure ahead of the event. I've found that buy the rumor, sell the news often holds true, so I'll look to trim the position before the actual event takes place. This strategy has worked well for me over the years, but it only works if the underlying company is one I already believe in. I also size up when a core holding experiences a significant pullback and the technical setup looks favorable. If the fundamentals are intact and the narrative is still strong, I see drawdowns as opportunities. When Tesla fell to $102 in early 2023, many investors panicked. I didn't. I saw long-term support, solid fundamentals, and added aggressively. That entry point became one of my best trades of the year. My portfolio finished 2023 up 132%, a result that reflects not just strong picks, but disciplined sizing and timely execution, as tracked publicly on my eToro profile. Risk management without over-diversification. That doesn't mean I'm reckless. It means I concentrate where I've done the work. I don't spread my bets across 50 names. I hold a smaller number of high-conviction plays that I understand deeply. But I also make sure I'm not overexposed to a single theme. That's why I monitor sector weights, liquidity risk, and correlation between holdings. It's not just about picking winners. It's about ensuring your winners aren't all tied to the same risk factor. Real-world portfolios, or example. At the time of writing, Tesla, Palantir, and NVIDIA make up a large portion of my portfolio. These are my high-conviction, future-facing core positions. Coinbase and SoFi are sized more modestly, but they represent strong optionality if their sectors mature. I maintain small allocations to test new ideas, sometimes rotating based on macro shifts or liquidity cycles. This isn't static. I rebalance as conviction increases or thesis conditions change. Visualizing portfolio strategy. Think of your portfolio like a pyramid. The foundation, 50–70%, is your core. Durable, long-term positions with deep conviction. The middle layer, 20–40%, is for satellite plays, tactical, trend-aligned, or thematic trades. The tip, 0–10%, is reserved for experimental or high-risk/high-reward ideas. Position scorecard and self-audit. Before I decide on size, I run through a simple checklist. Is the macro backdrop aligned with this idea? Do the technicals suggest this is an attractive entry point? Has the company shown strong execution and guidance? Is this correlated with my existing positions? Am I prepared to hold through volatility if needed? This checklist keeps my decisions intentional, not reactive. This quick exercise has helped dozens of investors I've spoken to, and I still do it myself from time to time. Lessons from poker and position sizing. Before I became a full-time investor, I played poker at a semi-professional level. It taught me a lot about risk, odds, and discipline. But one of the biggest lessons I carried over into investing was about sizing. In poker, if you're holding a strong hand, you size your bets aggressively. If your hand is mediocre or uncertain, you check or bet small to minimize risk. It's the same principle in investing. When my thesis is strong, backed by fundamentals, macro alignment, and technical support, I size up. When conviction is still building, or when risk is higher, I stay light and patient. Poker trains you to separate emotion from execution. You don't go all in just because you're bored or frustrated. You move with intention. Investing should be no different. The psychology of position sizing. Most people size based on emotion. They go big when they're excited or double down after a loss. That's not strategy. That's gambling. I size based on process, not price action, not hype, not fear. That's how I stay consistent, even when markets aren't. But I've made mistakes too. Early on, I oversized a few positions based on hype and paid the price. It taught me that risk management isn't about avoiding conviction. It's about knowing when conviction turns into overconfidence. There's also a mental trap in thinking small positions don't matter. But those tiny allocations add up, especially when unmanaged. I've learned to treat every position, even small ones, with the same level of discipline. Position sizing isn't just about math, it's about mindset. Most investors are comfortable adding to a winner when things feel good, but sizing down is much harder. It requires emotional detachment and the discipline to reevaluate your thesis. Sometimes the hardest decision is trimming a position that's doing well. But if a stock becomes an outsized portion of your portfolio, even if it's performing, it can expose you to unintended concentration risk. That's why I regularly review each holding's weight, not just in terms of conviction, but in terms of portfolio balance. I've had to reduce exposure to some of my biggest winners, not because I stopped believing in them, but because I believe in managing risk even more. Letting winners run is important, but so is protecting your downside. On the flip side, it's just as difficult not to double down on a loser purely out of ego. In the past, I've been tempted to average down on a bad idea, not because it made sense, but because I wanted to prove myself right. That's not investing. That's emotional gambling. Sizing should reflect clarity, not emotion. Increase when your thesis strengthens and conditions align. Decrease when the risk outweighs the reward, even if it's hard to let go. Case study, rotating from Bitcoin to Tesla. In April 2025, I made one of the most strategic trims of the year. Bitcoin had rallied hard and sentiment was euphoric. Meanwhile, Tesla was under pressure, weighed down by short-term headlines around Elon Musk's involvement with Doge, the U.S. Department of Governmental Ethics. While the crypto crowd was cheering BTC's momentum, I saw an opportunity. I trimmed a portion of my Bitcoin holdings and rotated the capital into Tesla move that at the time looked contrarian. Over the next few weeks, Bitcoin rose another 24%, but Tesla, it surged more than 50%. This wasn't about guessing short-term price moves. It was about capital efficiency. I believe Tesla had greater asymmetric potential from that point, based on technical support, narrative disconnect, and long-term fundamentals. That rotation didn't dramatically change my portfolio alone, but a handful of these premium decisions each year add up. They create real alpha, the kind you can't get from just holding passively. Trimming isn't always about de-risking. Sometimes it's about reallocating to your highest conviction opportunity. In this case, Tesla rewarded the move with a sharp rebound that outpaced the entire crypto sector. Position sizing mistakes to avoid. Even experienced investors make mistakes when it comes to sizing. Here are some of the biggest traps I've seen and experienced myself. Oversizing hype trades. Just because something is trending doesn't mean it deserves 10% of your portfolio. If you can't explain the thesis in detail, size conservatively. Doubling down emotionally. Increasing a position out of frustration or a need to make it back usually backfires. Ignoring correlation. Holding 5 tech stocks that all move together isn't diversification. Your sizing should account for correlation across the portfolio. Letting positions balloon unchecked. When one winner runs far ahead of the others, it can distort your risk balance. Trimming isn't defeat, it's discipline. Sizing too small to matter. A 0.5% position that triples doesn't move the needle. Small bets are fine, but manage them intentionally. Avoiding these mistakes has helped me stay focused and efficient, sizing not for excitement, but for impact. The role of cash and dry powder. I'm mostly fully invested. I believe in having my capital work for me at all times. But there are exceptions. If I see a high conviction setup forming, I may hold back a small amount of cash in anticipation. I don't try to time the market, but I do try to time my edge. Having dry powder gives me optionality when an asymmetric opportunity shows up. Whether it's a market-wide sell-off or a temporary dip in a core position, I want to be ready to act without having to sell something I still believe in. Cash is not a permanent strategy for me. It's a tactical one. But used correctly, it adds flexibility, clarity, and confidence. How my sizing strategy has evolved. When I first started investing, I sized everything emotionally. If I was excited about a stock, I'd go big. If I felt uncertain, I'd take a tiny position, even if the idea was sound. My approach was reactive, not structured. Sometimes it worked. Most times it didn't. Over time, I began to treat portfolio construction more like architecture. It's not just about picking the right bricks, stocks, but about how weight is distributed, sizing. Now, every allocation in my portfolio serves a purpose. I know why something is sized at 10%, and I know why something else is sized at 2%. That shift from intuition to intention changed everything for me. It reduced anxiety, it made my portfolio more resilient, and most importantly, it gave me the confidence to hold through the inevitable storms of the market. Tracking and visualizing sizing in practice. To keep my sizing discipline, I rely on visual tools. One of my favorite ways to audit my portfolio is by using a heat map, either through eToro's built-in allocation charts or my own spreadsheet models. I color-code positions based on weight, performance, and sector. This allows me to spot any concentration risk, correlation overlap, or drift from my intended core/satellite structure. If something starts ballooning, I'll know, and I'll act accordingly. Simple visuals can keep you honest. They turn your portfolio into a dashboard, not just a list. This quick exercise has helped me and dozens of investors I've spoken to. I still do it from time to time. No, try this, your 5-minute sizing audit. If you want to bring structure to your portfolio, start here. List your top 5 holdings. Are they sized in line with your conviction? Are any of them highly correlated? Could you sleep well if the largest one dropped 30%? No. If the answers make you nervous, your sizing might not match your strategy. Use this moment to recalibrate. Remember, sizing is a reflection of clarity, not confidence alone. Final thoughts. Position sizing isn't just math, it's mindset. It reflects your clarity, conviction, and ability to manage risk under pressure. You can have the best stock in the world, but if you size it wrong, you either dilute your returns or expose yourself to unnecessary damage. Learning to size with intention, not emotion, was one of the most transformative shifts in my journey. It helped me sleep better at night, trust my process, and stay in the game long enough to let compounding work its magic. It's not about being aggressive, it's about being strategic. Because when your size matches your belief, your entire portfolio becomes a reflection of discipline. Freedom keys. Sizing is your silent edge. It's what separates hobbyists from professionals. Conviction should match allocation. If you wouldn't buy more on a 30% dip, it's not a core position. Use a core satellite structure. Concentrate on your strongest ideas but leave room for optionality. Risk isn't just what you hold, it's how much you hold. Watch for overconcentration and emotional bias. Every position should have a purpose. No placeholders, no passengers, just deliberate capital. Simplicity scales. A well-sized portfolio is easier to manage, rebalance, and stick with through volatility. Call to action. Take a moment to reflect on your portfolio. Are your highest conviction ideas sized appropriately? Or are you letting emotions, excitement, fear, or regret dictate your allocations? Start thinking like a strategist, not just a stock picker. In the next chapter, I'll show you how I turn planning into execution and how I avoid the most common traps that sabotage even the best ideas. Chapter 7, Execution, where strategy meets reality. Most people think the hardest part of investing is picking the right stocks. After all, we're bombarded with headlines about hot tips, 10-bagger opportunities, and the next big thing. It's easy to think that if you just find the perfect company, everything else will fall into place. But in reality, execution is where most investors lose money, not because they picked wrong, but because they acted wrong. They bought too high out of FOMO, chasing a chart that looked unstoppable. They sold too low out of fear, watching red candles pile up and wanting to protect themselves from more pain. They traded too often, hoping to capture every tiny move, or they froze and did nothing when opportunity knocked. Execution is where psychology collides with process. It's where conviction meets discipline and where every investor's true character is revealed. Even the best stock pickers in the world can underperform if they can't manage their emotions, size their positions properly, and stick to a plan when markets get volatile. Execution isn't about calling tops and bottoms. It's about having a repeatable process that removes emotion and adds structure to your decisions. It's about understanding when to buy, how much to buy, when to add, and when to step aside, all without letting noise, hype, or fear take the wheel. In this chapter, I'll share how I developed my own execution framework, the one that's allowed me to navigate everything from the chaotic crypto crashes to the euphoric AI rallies. I'll break down how I scale in, how I manage risk, and how I avoid the traps that catch most investors off guard. Because at the end of the day, it's not just about picking the right ideas. It's about turning those ideas into real results. Why timing the market is a trap. Early in my journey, I tried to time everything. I'd wait for the perfect bottom, then miss it. Or I'd sell after a big run-up, only to watch it go another 50%. I learned the hard way that precision timing is a myth. Even pros with all the tools and data still get it wrong. No, that's when I shifted my mindset. I stopped trying to catch the bottom and started asking, is this asset undervalued relative to its future potential? Is the narrative intact? Is this a reasonable place to start or add more? If the answers were yes, I acted. Perfect timing wasn't the goal. Disciplined exposure was. Smart entries and scaling in. I rarely go all in on a position at once. Instead, I scale in, building a position in stages as the price action, macro backdrop, or company execution improves. This helps me avoid becoming trapped by short-term volatility. If I like a company at $80, I might buy 50% of my planned size. If it dips further with improving fundamentals, I'll slowly add more. This also applies when I'm buying the dip. I don't just pile in on the first sign of a pullback. Instead, I add incrementally, waiting for technical confirmation or signs that the market is stabilizing. Scaling allows me to average down responsibly while managing risk and staying emotionally neutral. Despite being long-term focused, I still rely on technical analysis to fine-tune my entries and exits. I'm not trying to day trade. I'm trying to tilt the odds in my favor. I look at support and resistance zones, oversold levels using RSI or volume surges, breakouts after long consolidations. These help me identify when to act on my thesis, especially during volatility. For example, if Palantir drops 20% but bounces off a multi-month support level with strong volume, that's often my signal to scale in further. Buy the dip, buy blindly. I buy dips, but not just any dip. A falling knife is very different from a healthy pullback. And before buying, I ask, has the long-term thesis changed? Is the market panic emotional or fundamental? Are broader liquidity conditions supportive? Is technical support holding? Back in 2022, during a big sell-off in growth stocks, I was so confident in one company's long-term story that I jumped in too quickly without checking technicals or broader liquidity. The stock kept falling another 30% before finding its bottom, and I had no room left to average down. That taught me that buying dips is an art, not just a science. A calm head during panic, the Trump tariffs. When the Trump tariffs were reintroduced in 2025, fear and uncertainty surged across the markets. Headlines were chaotic and many investors ran for the exits. But to me, it was short-term noise, not a structural shift. I believed the impact would be temporary and the market would correct itself once the emotional dust settled. Instead of panicking, I began buying the dip in increments. I didn't rush in all at once, but watched how the market reacted and scaled in at key support levels. My thesis remained intact, and the macro backdrop still favored a rebound. That decision to stay calm, stick to my plan, and trust my framework paid off, not just in returns, but in reinforcing my discipline as an investor. Event-driven execution with a plan. I sometimes size up ahead of a major catalyst, but always with a plan. For example, with Tesla's upcoming robotaxi announcement, I may increase exposure during the build-up, then tactically trim just before the reveal. But trimming doesn't mean exiting entirely. I'll usually reduce the tactical portion I added for the event while still holding a large core position based on my long-term conviction. It's not about flipping in and out. It's about adjusting exposure based on risk and narrative. This layered approach lets me capture upside from short-term sentiment while staying true to my broader strategy. Markets often operate on buy the rumor, sell the news, and by planning ahead, I avoid emotional reactions and exit at strength, not weakness. When I exit and when I don't. I don't exit just because something's gone up. I exit when the original thesis is no longer valid. A better opportunity emerges. Position size grows too large versus my portfolio. That said, I often hold through volatility if conviction remains high. If I believe a company will be worth multiples in 5–10 years, I don't let a 20% dip shake me out. The role of liquidity windows. Liquidity isn't just macro, it's timing. There are moments when market volume spikes, spreads tighten, and exits, or entries, are easier. Trying to execute in thin markets, especially during panic, often means getting a terrible fill. That's why I prefer to act when markets are calm and volume is flowing. Patience over FOMO. Sometimes the best trade is not trading. Patience pays, especially when others are panicking or chasing. I've sat on the sidelines while the market ran up, then entered during a cleaner setup. I've waited weeks before adding to a core position, just to see it fall into my technical sweet spot. That patience is a superpower most investors ignore. FOMO is one of the most dangerous forces in investing. It pushes you to chase green candles and buy hype tops. I've learned to ask myself, am I reacting to the chart or the story? Is there real fundamental momentum here? What's my edge by entering now? Most of the time, if I feel FOMO, I wait, or I size very small. If the opportunity is real, there will always be another setup. Mental discipline over price action. Execution is 80% mental. If your thesis is strong, don't let short-term price swings break your strategy. I don't use stop losses. I monitor the market daily and prefer to rely on my own judgment rather than preset triggers. If something fundamentally changes or the macro backdrop shifts in a way that breaks my thesis, I'll exit, but only after reviewing the data in real time. My risk is defined by conviction and thesis durability, not arbitrary price action. A mistake that taught me everything. One of the biggest mistakes I made early on was going all in on the first dip. I thought I was being bold and decisive, but it left me with no dry powder when the stock dipped even further. Watching the price continue to fall without having any capital left to average down triggered emotional stress and second-guessing. That experience taught me the power of proper sizing and capital preservation. Now, even when I strongly believe in a position, I always leave room to add more. If it dips lower and the thesis still holds, I see it as a gift, not a threat. This takes the emotion out of downswings and reinforces a strategic, not reactive, mindset. A case study in patience. Waiting for NVIDIA. In April 2024, NVIDIA was on a tear. The hype around AI was reaching fever pitch, and the stock had just hit a short-term high. Many investors were piling in, afraid of missing the next leg up. But I held back. Rather than chase strength, I waited for a clean technical setup, a retracement into a key support zone I had been tracking for weeks. That discipline paid off. I entered at a 21% discount from its recent high, at a time when sentiment had cooled just enough to create a more asymmetric opportunity. That entry wasn't luck. It was the result of a process I've honed over years, watching price action, managing emotions, and waiting for the market to offer me a better risk-reward setup. I still hold that position today. My execution readiness filter. When I'm about to enter a trade, I quickly run through 5 questions. Is this a high-conviction idea I've already researched? Has the stock pulled back into a technical or psychological support zone? Are liquidity and volume confirming the move? Is my position sizing plan already mapped out? Am I acting from strategy or reacting to emotion? And if I can't confidently answer yes to at least 4 of these, I wait. Execution should be systematic, not spontaneous. One mental trick I use before acting. When emotions are running high, I pause and ask myself one question. If I didn't already own this position, would I be buying it today at this price? That simple thought exercise helps me reframe bias. It prevents me from holding on to losing trades out of ego or selling winners too early out of fear. It saved me more times than I can count. Execution is the edge. Ideas are everywhere. You can find great stock picks on social media, in podcasts, and on earnings calls. But execution, calm, methodical, emotion-free execution is rare. Execution is what turns good ideas into great results. It's what compounds wealth over years. Not the one big winner, but the process of sizing well, acting with clarity, and avoiding the traps others fall into. That's why I treat execution like a skill to master, not a box to check, because in the end, that's what separates noise from results. Final thoughts. Execution is the bridge between intention and results. You can have the clearest thesis, the sharpest research, and the best tools, but without disciplined action, none of it matters. Most investors don't fail because they picked the wrong stock. They fail because they let emotions dictate their moves. They buy too late, sell too early, freeze during chaos, or chase during euphoria. True execution is about more than hitting a buy button. It's about having a repeatable system. It's knowing when to scale in, when to wait, when to trim, and when to walk away. It's about stacking small edges, better entries, more intentional sizing, fewer emotional decisions. Over time, those edges compound into outperformance. Great execution doesn't mean calling tops and bottoms. It means removing guesswork and acting with clarity. It's about following your process even when the noise is loud, trusting your plan when volatility rises, and staying patient when everyone else is chasing the next big thing. When you master execution, you stop reacting and start positioning. You trade not with fear, but with focus. That's when your strategy starts delivering results, and your investing moves from theory to transformation. Freedom keys. Execution is where most investors fail, not because of bad ideas, but because of bad habits. Scaling in beats going all in. Build positions with patience, not impulse. Buying the dip only works when the thesis is intact. Don't confuse panic with opportunity. Emotional execution leads to regret. Strategic execution leads to results. A clear entry plan reduces hesitation. A clear exit plan prevents panic. Discipline compounds. Your edge isn't finding the right stock, it's executing it the right way. Call to action. It's not the fast trades that build wealth. It's the consistent ones, executed with clarity and conviction. Think back to a trade you regret, not because the idea was wrong, but because of how you executed it. What would you do differently today? Take a moment to reflect on your overall approach. Are you trading with discipline, or are you chasing noise? Do you have a repeatable plan, or are your decisions driven by emotion? In the next chapter, I'll share how I manage volatility, stay calm during chaos, and hold strong when the market tries to shake you out. If you're enjoying The Freedom Investor, you can connect with Tony and get his latest market insights at thefreedominvestor.com. That's where he shares portfolio updates, new blog posts, and his exclusive quarterly newsletter packed with deep macro analysis and the stocks he's watching next. Chapter 8. Staying invested through the storms. How I handle volatility, corrections, and bear markets while keeping my long-term vision. I've been through enough red screens and panic headlines to know that these moments, as painful as they are often the defining ones. Not because of how much you lose or gain in the short term, but because of how you respond. Over time, I've learned how to not just endure drawdowns, but turn them into confidence-building exercises. They've made me sharper, calmer, and more focused on the long game. One of the earliest and most brutal lessons came during the 2017 crypto crash. I jumped into Bitcoin and altcoins with the excitement of a pioneer, watching prices skyrocket as the world buzzed about blockchain and digital gold. Then, seemingly overnight, the market tanked, 80% gone in months. Every day felt like another gut punch. It was one of the largest crashes I'd ever witnessed, and it felt like the entire world was falling apart. I panicked, questioned everything, and considered selling just to escape the stress. But I didn't. I held on with diamond hands, determined to see it through. That experience was a turning point. It made me realize that volatility is part of the game, and that if I could handle an 80% drawdown without panic selling, I could handle just about anything. That crash forged a mindset that's unshakable today. I've been there, done that, and I know I can survive even the toughest storms. One decision, years of impact, mind over market. Volatility doesn't break portfolios. Emotions do. You can have the best thesis in the world, but if you panic, sell at the bottom, none of it matters. In the early days, I'd let red days rattle me. I'd question my analysis, stare at charts, and scroll through endless headlines. But now that I've matured as an investor, I genuinely don't care what happens in the short term. I know that noise is just that, noise. It's not the story, it's not the thesis, and it's certainly not the big picture. What matters is whether the underlying company is executing, whether the macro environment is supportive, and whether my thesis is intact. They're the only things that matter to me now. This mindset shift was key. I stopped trying to control the market. Instead, I focused on controlling my reactions. The COVID crash, the shock that taught me calm. In March 2020, the entire market collapsed as the world shut down. Fear was at extreme levels. Even strong companies with little exposure to COVID were down 30 and 50%. It was tempting to sell everything and wait for clarity. But clarity never comes in the moment. What helped me stay in and even buy more was stepping back and asking, in 3 to 5 years, will these companies still be leading? Will the world recover? My answer was yes. I didn't nail every bottom, but I didn't need to. By holding steady and adding where I had conviction, I turned panic into positioning. When the drawdown that built my discipline. There's no sugarcoating it. 2022 was one of the toughest years I've experienced as an investor. Rising interest rates crushed tech valuations, sentiment flipped almost overnight, and every strategy that worked in 2021 seemed to break. It felt like nothing was working. My portfolio was down about 58%, which on paper looked devastating. But because I held on and kept buying the dips, that drawdown ended up being just a small dent in the bigger picture. I wasn't holding microcap stocks or random coins. I was invested in strong companies with real businesses and growth potential. I knew that if I stayed focused on the right companies, the ones building the future, then the market would eventually reward patience. And that's exactly what happened. In 2023, my portfolio rebounded 132%, and in 2024, it gained another 78%. eToro, username, Tony Shiki. That experience proved that sticking to a long-term, conviction-based strategy works, even when the market feels like it's testing every nerve. Those years taught me that drawdowns aren't just a test of your portfolio, they're a test of your mindset. They forced me to get comfortable with discomfort, to trust the process, and to remind myself that short-term pain is the price of long-term gains. What keeps me grounded? That same mindset is something I try to pass on, especially to those who copy me on eToro. While my portfolio is usually fully invested, I always maintain savings outside the market. This reserve gives me peace of mind. I know I have capital ready to deploy when true opportunities appear. It's what lets me sleep at night. During deep market corrections, I don't panic. I see them as golden moments, times when great companies are trading at a discount and fear is high. To me, that's when the game gets exciting. I believe that if things ever get too bad, the Fed or central banks will step in, inject liquidity, and stabilize the system. That belief is grounded in decades of market behavior. So I treat downturns like sales. The mentality is simple. It's like walking into your favorite store and everything's 50% off. What more could you want? What keeps me grounded isn't just portfolio structure. It's clarity in my thesis and confidence that I'm prepared for the volatility that others fear. I know what I own, I know why I own it, and I know what would make me change my mind. That confidence doesn't come from hope. It comes from preparation, talking to my copiers. I've even had copiers reach out during big market drops, worried about the red, but I remind them of the same framework I use. Has the thesis changed? Is this panic or opportunity? More often than not, those scary moments become turning points, and staying invested made all the difference. I call this mindset inverse FOMO, the fear of missing out on once-in-a-cycle entries while everyone else is panicking. When you truly believe in your strategy, red days don't scare you. They excite you. Journaling for clarity. Sometimes I even journal my logic during drawdowns. Just a few lines. It's a habit that reinforces discipline. Later, when the dust settles, I can look back and see that I had reasoning, not just blind hope, behind my decision to stay in. Why most investors fail during corrections. Most investors fail not because they lack skill, but because they lack resilience. They give in to fear, follow the crowd, and abandon their plan just when the best opportunities are appearing. In bear markets, liquidity vanishes, sentiment turns toxic, and headlines go from negative to apocalyptic. That's when retail capitulation kicks in, and when patient, prepared investors quietly accumulate. The people who lose during downturns aren't the ones who held strong companies. It's the ones who sold them too soon. I've learned that drawdowns are less about financial loss and more about emotional control. Your account might be down, but if your head is still in the game, you haven't lost a thing. Historical perspective. Every crash has an exit. Zoom out on a long-term chart of the S&P 500, and you'll see this clearly. Every major crash, 2000, 2008, 2020, eventually gave way to new all-time highs. Despite multiple crises, the market continued climbing. Time in the market beats timing the market. Those who endured those moments were rewarded. Those who panicked missed the next leg up. The same is true of any innovation-led cycle, whether it's tech in the early 2000s, crypto in the late 2010s, or AI today. Volatility is baked into disruption. Long-term investors understand this. They use crashes as launch pads. Quick rules. I live by during drawdowns. Don't sell weakness. Weakness often signals opportunity, not defeat. Buy dips only when your thesis is intact. Panic buying can be as bad as panic selling. No, watch your emotions more than your screen. Your head can sabotage your returns. Stay humble, but stay in the game. Arrogance kills portfolios faster than any bear market. The rebound always feels impossible until it happens. Then you're glad you didn't blink. Naden, a mistake I nearly made, and what it taught me. In late 2022, after watching one of my core holdings fall nearly 40%, I was this close to selling. Not because the fundamentals had changed, but because the red was relentless and emotionally draining. I pulled up the sell window, hovered my finger, and then stopped. Instead of exiting, I opened my journal and wrote down 3 things: why I bought the company, whether the story had changed, and what I wished I had done in hindsight. I held. That stock eventually rebounded and doubled. It was a reminder that panic is loud, but process is louder, if you're willing to listen. That one decision to pause, reflect, and recommit added more to my returns than any newsletter or chart ever could. The 3 are rule for volatility. When volatility spikes and doubt creeps in, I follow a simple framework. Review the thesis, reaffirm conviction, or revise it if facts have changed. Respond with intention, not emotion. This keeps me anchored, because how you act in chaos is what defines you in compounding. Final thought. The best investors aren't fearless. They just know how to act when fear takes over. They've trained themselves to pause when others react, to analyze when others assume, and to execute with discipline when others freeze. That's the difference between reacting to the market and mastering it. In the end, it's not about emotionless perfection. It's about choosing clarity over chaos in the heat of the moment. Morgan Housel says, "Volatility is the price of admission for long-term returns." I've learned that drawdowns are inevitable, and that it's not enough to prepare financially. You have to prepare emotionally too. Markets will always go up over the long term if you're in the right names. If you're in the strongest companies with real products and solid growth, there's nothing to fear. Your biggest edge is staying rational when others are reactive. It's about seeing red screens and recognizing opportunity in them, not catastrophe. If your conviction is real, volatility is opportunity. It's not something to fear, it's something to embrace because it's in those scary moments that the best entries appear. Freedom keys. Volatility is inevitable. Your response is optional. Emotional reactions are what destroy long-term returns. Drawdowns are tests, not verdicts. Conviction built on real research will hold when prices fall. Crashes are buying opportunities in disguise. When fear peaks, future gains are often hiding in plain sight. Stay liquid, stay ready. Keeping reserves gives you confidence to buy when others panic. Journaling sharpens clarity. Writing down your thinking during tough times reinforces discipline. The rebound always feels impossible until it happens. Stay in the game long enough to see the cycle turn. Call to action. Next time the market dips and fear takes over, pause and ask yourself, is this panic or opportunity? Stay focused on your conviction, trust your process, and remember that volatility is the price of admission for long-term success. The storms will come, but your response will define your results. In the next chapter, I'll explore how powerful stories drive markets and how to identify the narratives that can fuel your next big investment win. Chapter 9. Investing in Stories. Why narrative-driven investing matters and how to find the next big idea. I learned this firsthand during my years in the crypto space. Even though I never invested in Dogecoin, watching it skyrocket taught me a valuable lesson about the power of network effects and community. Even if a coin offered no real-world value, a strong community and compelling story could send it soaring. That experience left an indelible mark on how I see investing. Sometimes it's not just the fundamentals that matter, but the collective belief that propels an idea forward. But unlike the hype-driven meme coins, I now apply that insight to investing in companies with real products, solid growth prospects, and strong fundamentals. Companies that combine a powerful story with sustainable execution. Humans are storytelling creatures. We crave narratives because they help us make sense of a chaotic world. In investing, stories give us something to believe in, a reason to hold, to buy, to hope. That's why stories move markets faster than any spreadsheet ever could. They spark FOMO, ignite rallies, and even sustain long-term trends that outlast the initial hype. It's easy to dismiss this as irrational, but it's also reality. If you want to thrive in today's hyper-connected markets, you can't ignore the power of narratives. You need to understand how they form, why they spread, and how to separate the ones that are truly transformative from the ones that are all talk. Valuation isn't everything. The traditional school of investing says, run a DCF model, compare PE ratios, buy when things look cheap. That worked in the past. But in today's world where information travels at lightning speed and innovation moves even faster, that approach can make you miss the biggest winners. Morgan Housel. Say the most valuable companies in the world were never obvious investments. If everyone sticks strictly to value investing and DCF models, then by definition, the majority of the best performers will always look too expensive. Amazon, Tesla, Nvidia, the darlings of modern investing, were all overvalued by classic metrics for most of their ascent. But while the spreadsheet said too expensive, the market was pricing belief, innovation, and network effects that simply couldn't be captured in a single model. DCF models are built on assumptions, and they often assume a future that looks a lot like the past. But the companies that change the world rarely follow that script. They grow faster, build new categories, and capture market share in ways traditional investors underestimate. If you stick too rigidly to value investing, you'll be on the sidelines while the real value is being created. Modern investing rewards those who can spot where the world is heading, not just where it's been. Narratives are the bridge between current price and future potential, and in today's markets, they can carry you to places no DCF model could ever predict. How I identify emerging narratives. It starts with a simple question. Where is the world heading in the next 5 and 10 years? To evaluate whether a narrative has staying power, I use a few key filters. Tech adoption curve. Is the trend still in the early innings? I want to catch themes before the majority of adoption, not after. Policy and regulatory tailwinds. Are governments or institutions supporting the theme with subsidies, incentives or regulatory shifts, consumer behavior shifts. Are end users clearly adopting or demanding the change? Capital flow. Are venture capitalists, institutional investors, or insiders allocating significant capital to this theme? Competitive advantage. Does the company have a moat in executing this trend? Narrative without execution is just noise. I track policy shifts, technological breakthroughs, and consumer behavior trends. I read what VCs are backing, watch where institutional money is flowing, and study the macro signals that show where liquidity is headed. I'm not trying to predict the future. I'm trying to position for it. Why some narratives outlast others. One of the greatest examples of this is Steve Jobs and Apple. Jobs was a master storyteller, not just in product launches, but in how he positioned the company itself. He didn't sell tech specs, he sold dreams, simplicity, and a vision of the future. From the Think Different campaign to unveiling the iPhone as a revolutionary device, Jobs understood that people don't just buy products, they buy into stories. That storytelling gave Apple an edge that no spreadsheet could capture. Investors who believed in that vision, even when the fundamentals looked stretched, were rewarded massively over time. We've seen this pattern repeat with other icons too. Tesla started as a car company story. Now it's an energy, autonomy, and robotics play. Apple went from personal computers to devices to a lifestyle ecosystem. The common thread? Execution. The story gets layered as the company delivers. I look for companies where the narrative deepens over time. Is the management expanding the vision? Are new verticals being unlocked? Are users becoming evangelists, not just customers? These are signs that a story isn't just compelling, it's durable. My narrative checklist. Before I invest based on a story, I run through this mental list. Is the story compelling and rooted in something real? Is the company executing or just promoting? Are institutions or insiders buying in? Can I hold through volatility if the price doesn't follow right away? Is this the kind of story that could reshape an industry? If most of those answers are yes, I pay attention. Avoiding narrative traps. Not every hot story is investable. Several years ago, I closely watched the cannabis sector as it captured investor excitement. Headlines were bullish, early movers rallied hard, and everyone was talking about a green rush. But the fundamentals didn't support the valuations. There were regulatory uncertainties, weak unit economics, and overextended valuations across the board. The story was exciting, but it didn't pass my filter. Will this company still be a leader in 5-10 years? That decision to stay out saved me from major drawdowns. Narrative investing isn't about hype. It's about conviction in the direction of the world. I don't chase the trend end of the week. I position early in themes that align with long-term transformation. I also watch for signs of unsustainable hype, parabolic price moves with no underlying earnings growth, management overpromising, or investor euphoria with no base case. Pump and dump schemes are the most dangerous version of narrative traps. They often start with a viral story, manufactured urgency, and price manipulation, designed to lure in retail traders before insiders quietly exit. I've seen this play out across penny stocks, obscure crypto tokens, and even small-cap tech firms. If something rallies 100% in a day without a clear catalyst or roadmap, be suspicious, not seduced. The crypto world is full of these stories too, coins that go vertical on hype alone, only to crash when reality sets in. If you know the outcome, you'll see the journey. That philosophical concept sums up how I invest. If I'm confident in the destination, I can stomach the dips, the sideways periods, and the media noise, because I know where this is going, and I know why I'm holding. Narrative investing is never smooth, but when the story unfolds as expected, the rewards are exponential. The crowd arrives late. You got in when conviction mattered. Holding through volatility is the real test. I've learned that the most compelling stories often face the strongest headwinds, but that's where the best opportunities hide. When you believe in the destination, the bumps along the way are just that. Bumps, not roadblocks. Final thoughts. Narratives aren't just buzzwords. They're how markets make sense of the future. They shape perception, drive capital flows, and often lead price action before the fundamentals catch up. Some of my biggest returns came from betting early on trends that made sense to me long before they made sense to Wall Street. It wasn't about chasing hype. It was about recognizing where the world was heading and getting positioned before the crowd. The goal isn't to ride every wave. It's to catch the right ones early and hold through the noise with conviction. That's where real upside lives. But when the story changes, I adapt. Narrative investing isn't about being stubborn. It's about being intentional. The best investors stay curious, stay open, and stay focused on the bigger picture. Because if you can see what's coming, you don't have to react. You're already positioned. Freedom keys. Narratives move markets faster than fundamentals. Learn to spot belief-driven flows before the numbers catch up. People invest in visions, not just valuations. The story behind a company often drives its price more than spreadsheets do. Early conviction in a strong narrative pays off. By the time Wall Street catches on, the biggest gains are often gone. Stories deepen with execution. The best companies keep adding chapters, new markets, stronger moats, expanding missions. Don't chase hype, pursue transformation. Lasting narratives come from real innovation, not viral buzz. You don't need to catch every wave, just the right one, early enough. And hold with belief when it gets uncomfortable. Call to action. Next time you're evaluating an investment, ask yourself, what's the story here? Who's telling it and who's listening? If the narrative makes sense and you believe in the destination, then lean in. That's where the magic happens. Because in the markets, the story you believe in, and when you believe in it, makes all the difference. In the next chapter, I'll show you why thinking in decades, not days, is the ultimate edge in building lasting wealth. Chapter 10. Thinking in decades. Building wealth with patience and a focus on compounding returns. When I first started investing, I was no different. I wanted to catch every move, every bounce. I thought I could time the market and trade my way to success. I remember days when I'd stare at charts for hours, trying to find the perfect entry or exit, thinking speed equaled skill. But slowly the game changed for me. I began to notice a pattern. The investors who were truly building wealth weren't the ones making flashy trades or reacting to every headline. They were the ones quietly holding high-quality companies for years, sometimes decades. Their portfolios weren't exciting in the short term, but over time, they built extraordinary results. I started looking back at the trades I regretted most. It wasn't the ones I held too long. It was the ones I sold too early. I realized the biggest wins didn't come from perfect timing. They came from conviction, discipline, and the patience to let compounding do its magic. That's when I started thinking in decades, not days. And it changed everything, or why most investors fail in the long run. It's easy to get caught up in the day-to-day noise. CNBC screaming headlines, social media hype, analysts upgrading or downgrading stocks. The temptation to react to every move is strong, but every time you jump in and out of positions, you risk missing the biggest moves, the ones that happen when you're not looking. I've seen it over and over again. Investors who panic at the first sign of a pullback, sell at the bottom, then watch from the sidelines as the stock rebounds. They forget that some of the best days in the market often follow the worst days, and by trying to time those moves, they end up eroding their returns. Investors who focus on the short term often forget the power of compounding. They sell too soon, take small profits, and move on, only to watch the stock they sold double and triple or more. The real money is made by holding through the noise, letting winners run, and giving yourself time for conviction to pay off. Short-term thinking is often driven by emotion. Fear, greed, and impatience cloud rational judgment. It's in those moments of volatility that long-term thinking becomes your sharpest edge. The markets will always test you. The question is whether you'll flinch or stay the course. The power of compounding. It's the single most powerful force in investing, and the reason why thinking in decades matters. Albert Einstein. Say compound interest is the eighth wonder of the world. Let's say you invest $10,000 in a portfolio that averages 10% annual returns. After 1 year, you'd have $11,000. That doesn't seem like much, But after 10 years, that $10,000 grows to nearly $26,000. After 20 years, it's over $67,000. And after 30 years, it's more than $174,000. I've seen this firsthand in my own portfolio. After sticking to my core positions, my conviction in key names paid off. While many investors jumped ship, I stayed invested and even added to my positions. That's the power of compounding combined with patience and conviction, the backbone of long-term wealth creation. One of my best long-term holds was Palantir. I entered early when the stock was volatile and sentiment was mixed. But I believed in the data-centric world we were heading toward. Despite noise and pullbacks, I held, and over time, the market began to recognize the company's role in AI and national security. That conviction paid off not just in returns, but in reinforcing the power of time-tested patience. Thinking in terms of 5, 10, and 20 years. When I evaluate a company, I don't ask what it might earn next quarter. I ask, where could this business be in 5 years, in 10 years? Could it be a leader in its industry, a dominant player in a secular trend, a company that reshapes how we live or work? Long-term investing is about seeing the world not as it is today, but as it could be tomorrow. And it's about aligning yourself with megatrends that have the potential to change everything. Trends like artificial intelligence, automation, renewable energy, and the digital economy. Investing in companies with real potential requires patience. The next Tesla, Nvidia, or Palantir won't become household names overnight, but by getting in early, when the story is still unfolding, and holding through volatility, you give yourself the chance to capture extraordinary gains, navigating short-term volatility with a long-term lens. Markets are inherently volatile. Even the most robust companies experience fluctuations due to external factors, media narratives, and public sentiment. As investors, it's crucial to distinguish between short-term noise and long-term value. A great example from my own investing journey is Tesla during the period when Elon Musk was heavily involved with politics and the Department of Government Efficiency, DOGE. The media was in a frenzy, critics were everywhere, and social media was flooded with debates about whether Musk's involvement in politics was distracting him from Tesla. Amidst the noise, Tesla's stock price tanked, dropping 53% to around $222. Many investors panicked and sold, but I chose to stay the course, and in fact, I was aggressively buying the dip. This turned out to be one of the best dip buying opportunities I've ever had. My conviction in Tesla's long-term vision, leading the electric vehicle revolution, advancing autonomous driving, and innovating in renewable energy, remained unshaken. Fundamentally, the company was still executing on its roadmap, and the opportunities in AI, robotics, and energy storage were as strong as ever. That experience taught me the importance of focusing on the bigger picture. Short-term volatility often reflects transient emotions rather than real shifts in a company's potential. By staying focused on the core fundamentals and the secular trends driving growth, I was able to hold through the volatility and ultimately benefit when the market's attention shifted back to Tesla's innovation and execution. How to identify long-term winners. The best companies share a few key traits. They have visionary leadership. They're riding a mega trend that's reshaping industries. They have a competitive advantage that's hard to replicate. And they're financially disciplined enough to weather tough times. I look for companies that aren't just surviving today, but building the future. They're investing in innovation, capturing market share, and thinking beyond the next quarter. Those are the kinds of companies worth holding through volatility, because they're the ones that will be worth multiples of today's price in the years to come. Long-term investors checklist. Is the company riding a megatrend? Does it have a visionary founder or management team? Is there a durable competitive advantage? Can it survive and grow through multiple market cycles? Would I still want to own this 10 years from now? The patience premium. Patience is a competitive edge. Most investors want results now. They chase momentum and react to every headline. But the real opportunities come from sitting tight when others panic and adding more when prices are cheap. There was a time early in my journey when I let impatience cost me gains. I sold a position after a 15% gain, thinking I'd lock in the profits and find something better. Within a few months, that stock doubled, and I missed out on a massive run. That experience taught me that sometimes the best move is to do nothing, to let compounding work its magic while everyone else is chasing the next shiny object. Staying curious and adapting. Long-term investing doesn't mean holding blindly. The world changes. New technologies emerge. Consumer behaviors shift. Policies evolve. That's why it's important to stay curious, to keep learning, and to adapt when the facts change. Every quarter I review my core positions. I ask, is the thesis still intact? Are the fundamentals solid? Is the company executing on its vision? If the answer is yes, I hold. If not, I reassess and make changes. One time I was heavily invested in a company that seemed unstoppable, until it wasn't. A new competitor emerged, consumer preferences shifted, and the fundamentals started to crack. I could have held on out of stubbornness, but I chose to adapt. I reallocated that capital into stronger names that aligned better with the future I saw. That decision preserved my capital and set me up for future gains. Final thoughts. Thinking in decades is a mindset, one that separates investors from traders. It's about seeing beyond the headlines, ignoring the noise, and trusting that compounding and patience will do their job. Most people can't do it. They get too emotional, too reactive. They chase what's hot, panic when it cools, and rarely give their investments time to mature. But if you can adopt this mindset, you'll be ahead of 90% of investors, not because you're smarter, but because you're more consistent. And in investing, consistency wins. Decade-long thinking forces you to zoom out, focus on quality, and let the long-term thesis play out. It helps you stay calm during volatility and bold when the opportunity feels uncomfortable. When you think in decades, time becomes your ally. You stop trying to predict every move and start building something real. Charlie Munger says, "The big money is not in the buying and the selling, but in the waiting." Freedom keys. Compounding rewards. Time, not timing. The biggest gains often come after years of patience, not weeks of precision. Short-term noise is the enemy of long-term wealth. Zoom out and stay focused on the bigger picture. Most regrets come from selling too early, not holding too long. Trust your process and let winners run. Think in decades, not days. Align your portfolio with where the world is going, not where it's been. Valuations matter, but vision matters more. Market leaders often look expensive before their potential is fully priced in. Patience is a competitive advantage. When others flinch, you stay the course, and that's where real wealth is made. In call to action. Next time you're tempted to sell on a bad day or chase the latest hype, pause and ask yourself, am I thinking in days or in decades? The answer could change your entire investing journey. Take a moment to reflect. What's one stock or investment you exited too early, only to see it soar later? What was your reasoning at the time and what would you do differently now? Your edge isn't found in timing the market perfectly. It's found in mastering your mindset and letting time do the heavy lifting. Because long-term wealth isn't built in moments, it's built in decades. In the next chapter, I'll introduce the 10x mindset and how to spot the rare opportunities that can multiply your wealth and transform your portfolio. Chapter 11, the 10x mindset. Finding asymmetric opportunities that can change your investing life. Not every investment is created equal. Some are stable compounders, others are short-term trades, but a few, the rare few, have the potential to 10x. These are the investments that can change the trajectory of your portfolio and maybe even your life. This chapter is about those bets. When I first started investing, I thought every stock had equal potential. I treated each one the same. But over time, I realized that wasn't true. Some stocks are grinders. They'll give you steady returns year after year. But others have the potential to multiply, not just by 10%, but by 10 times or more. These are the asymmetric bets. They're rare, but they're worth hunting for. The mindset shift, from playing it safe to thinking exponentially. Early in my journey, I was naturally cautious. I'd analyze every stock to death, worrying about PE ratios, cash flow forecasts, and quarterly earnings beats. But something shifted when I started looking at the stories behind the numbers. The companies building the future, not just the ones that looked good on a spreadsheet. Crypto was a turning point for me. I watched Bitcoin transform from a speculative asset in 2017 to a mainstream conversation starter. I learned that even if something looked risky, if the upside potential was enormous and I sized it correctly, the payoff could change everything. That's the power of asymmetric bets. They don't just add returns, they can change your whole investing trajectory. What is asymmetry? Asymmetry means the upside far outweighs the downside. It's when the potential gains, if you're right, can be life-changing, while the downside is limited to what you invested. A real-life example? In early 2017, I was heavily invested in Bitcoin. At the time, it was still considered speculative and volatile. Many doubted it had staying power. But I believed in the asymmetric nature of the trade. The potential upside, as a disruptive, decentralized form of money, was enormous, while my downside was simply the capital I'd risked. That year, Bitcoin didn't just rise, it 20x'd. That kind of payoff is rare, but it highlights why asymmetric bets are worth the risk. I don't need to catch every rocket. I just need to keep spotting the launch pads. If you risk $1 to potentially make $10, that's asymmetric. It doesn't mean every trade wins. It means that when you're right, you win big, and when you're wrong, the loss is contained. In traditional finance, people think in probabilities. I think in payoffs. Carveth Reed says it is better to be vaguely right than exactly wrong. I'm not looking for what has the highest chance of going up. I'm looking for, if this works, what can it become? And that shift in mindset is everything. What asymmetric bets look like. They're not obvious. Most of the market calls them overvalued or crazy, but they usually share these traits. A powerful narrative tailwind, AI, EVs, decarbonization, etc. Founder-led or mission-driven companies. Massive addressable market. Early adoption with steep growth curves. High short interest or skepticism. These are the plays that don't make sense on traditional valuation models. Models like DCFs and PE ratios assume linear growth and predictable cash flows. But exponential opportunities often come from companies that break those models. For instance, many analysts passed on Amazon in its early days because it didn't fit neatly into profitability frameworks, yet it became one of the most valuable companies in history. Valuation models are helpful, but they often miss the nonlinear nature of exponential growth, especially when narratives in new markets reshape the landscape before the numbers catch up. A historical example, Amazon. Amazon went public in 1997 at under $2 per share. At the time, it was dismissed by Wall Street as just an online bookstore, with razor-thin margins and no clear path to profitability. But those who saw the vision, Jeff Bezos' relentless focus on customer experience, the early infrastructure investments in logistics, and the massive potential of e-commerce, understood that something bigger was unfolding. As competitors faded and Amazon built an unassailable moat through Prime, AWS, and scale, its stock kept climbing. Investors who held through the noise and disbelief didn't just make solid returns, they changed their financial future. That's the power of conviction in an asymmetric bet. If you stick to DCFs and PE ratios alone, you'll miss them. That's why I've moved beyond old-school value investing. In this new paradigm, narrative timing, macro the edge. Examples from my portfolio. I've lived this approach in my own investing journey, not in Palantir. While many dismissed it as a black box government contractor, I saw the emerging AI narrative forming. Their traction in defense, edge computing, and AI infrastructure was ahead of the curve. I built my position early and held through the sideways chop because I believed in where the story was heading. Tesla. Volatile, noisy, hated by Wall Street for years. But I understood the mission, the lead in battery tech, and the cult-like customer base. It's not just a car company, it's an ecosystem. I added aggressively on major dips, and those entries became some of my best performers. NVIDIA. During the early days of the AI boom, I saw the power of its CUDA software stack and the critical role it was playing in the AI revolution. Even though its valuation looked stretched by every traditional metric, I added exposure early, before the mainstream fully grasped the scale of the opportunity. A missed 10ing opportunity. One of my biggest regrets? Not building a larger position in NVIDIA back in 2018. I saw the potential, but I hesitated, thinking the valuation was too rich. That hesitation cost me serious upside. It taught me that sometimes valuation metrics lag behind reality when disruption is happening. Missing that opportunity drove home the importance of trusting vision, not just valuation. My framework for asymmetric setups. When I look for a potential 10x play, here's what I ask. 1. What's the macro trend? Is the world shifting in a way this company can ride? 2. Does the company have a moat, tech, brand, network, execution? 3. Can it scale massively? Global TAM, vertical integration, velocity of adoption? 4. What's the sentiment? Is it crowded or contrarian? 5. What's my risk? How much am I really risking versus what I could gain? I'm not afraid of volatility. I'm afraid of asymmetry I missed. How to stay in the trade. Most investors don't struggle with finding asymmetric plays. They struggle with holding them. The volatility, media noise, and social pressure often cause early exits. Here's how I hold through the chaos. I journal my thesis on day 1, so I have something to reference later. I track execution, not just price, because story ticker. I update my thesis, based not on fear, but on fundamentals. I remind myself, if it's uncomfortable, it might be early, and early is where the edge is. Position sizing for asymmetric plays. I don't YOLO my whole portfolio into these ideas. I size in according to conviction and risk, but knowing when to trim is just as critical. I typically start trimming when the price far exceeds my initial projections or the narrative gets too euphoric, when everyone suddenly loves what they used to hate. If the story hasn't changed but the price has run ahead far too fast, I'll take profits incrementally. However, I rarely exit entirely. I keep a core position if the long-term vision is still intact, letting that original conviction continue to compound. Managing asymmetric plays is about scaling, not swinging blindly. Think of these bets like planting seeds. You don't know which tree will grow the tallest, but you give the best ones sunlight, space, and time. The emotional side of asymmetry. Most investors struggle with asymmetric plays because they're uncomfortable. They often come with volatility, haters, and skeptics shouting, overvalued at every turn. But discomfort is often where the real opportunity lies. I remember when Tesla was constantly in the news for controversies. Elon's tweets, production challenges, short sellers betting on its collapse. The noise was deafening. But I trusted the mission, I trusted the execution, and I trusted the trend. That conviction turned out to be one of my best decisions. Of course, not every asymmetric bet works out. I've had plenty of ideas that looked promising, but ended up going nowhere, or even losing money. That's the nature of asymmetric investing. You accept that some of your bets will fail because the upside from the winners can more than make up for the losers. The key is to manage your risk, size your positions responsibly, and keep your focus on the long-term game. Final thoughts. Most people are playing the wrong game. They want certainty. I want upside. The best trades I've made didn't come from consensus. They came from seeing around corners and acting before the crowd understood the story. Consensus doesn't 10x, conviction does. If you want exponential returns, you have to think exponentially. In a world obsessed with safety and certainty, the real edge comes from embracing intelligent risk. Asymmetric plays aren't about being right. They're about being ready. One great idea can change everything, but only if you have the conviction to act when it feels uncomfortable. That's the 10x mindset, and it's what separates the average from the exponential. Your freedom keys. Asymmetric bets change the game. You don't need to be right often, just right big when it counts. Winning opportunities are rarely comfortable. Discomfort is often the signal that you're early, not wrong. Conviction comes before consensus. If everyone already agrees, the edge is probably gone. Narrative macro execution, exponential upside. That's the formula I look for and act on. You can't 10x playing it safe. Intelligent risk, not recklessness, creates life-changing returns. Missing one great opportunity often hurts more than making 5 mediocre ones. Focus on the few with massive potential and size accordingly. Call to action. Take a moment to think about your portfolio. Is there one idea you believe in that could have a 10x impact? Study it. Understand the narrative. Size it responsibly. And most importantly, be ready to act when the opportunity comes. What's one asymmetric opportunity you passed on because it felt too risky at the time? What would you do differently next time? Your edge isn't just in what you know, it's in how you act when conviction meets discomfort. Because in the world of investing, one asymmetric bet can change everything. In the next chapter, I'll shift gears from external opportunities to internal mastery and show you how managing your mind is the most important edge of all. If you're enjoying The Freedom Investor, you can connect with Tony and get his latest market insights at thefreedominvestor.com. That's where he shares portfolio updates, new blog posts, and his exclusive quarterly newsletter packed with deep macro analysis and the stocks he's watching next. Chapter 12. Mastering Your Mind. Avoiding emotional traps that sabotage investment success. You can have the perfect portfolio on paper, but if your mind isn't aligned, it won't matter. Behavioral biases quietly sabotage investors every day. The market isn't just a numbers game. It's a psychology game. And if you don't understand your own mental traps, you'll fall into them over and over. I learned this the hard way. Early in my journey, I'd get rattled by every red day, second-guess every trade, and jump on every hype train that crossed my feed. I let my emotions drive my decisions, and it cost me. I remember days when I'd be glued to the screen, letting every tick up or down influence my mood. It wasn't until I took a step back and realized that my psychology was the missing piece that everything started to change. This is why I always say, the investor's greatest challenge isn't the market, it's mastering themselves. The technicals matter, the fundamentals matter, but the psychology, that's what separates the consistent winners from the rest. Benjamin Graham says, the investor's chief problem, and even his worst enemy, is likely to be himself. Behavioral Finance, Why It Matters. Nobel Prize winner Daniel Kahneman and Amos Tversky's work in behavioral finance, particularly around prospect theory, laid the foundation for understanding why humans make irrational financial decisions. These insights matter more than ever in today's fast-paced markets, where information overload can amplify our worst tendencies. Knowing that we're wired for fear, overconfidence, and loss aversion isn't just interesting, it's actionable. Here are the most common psychological traps I've encountered and still wrestle with, even after years of investing. Confirmation bias. You seek information that supports what you already believe and ignore everything else. You follow accounts that agree with your position. You read articles that make you feel smart for holding. Or, how I fight it. I purposely seek out bear cases. I want to know what the other side sees. I don't need to agree, but I want to stress test my thesis. Sometimes I'll even ask AI tools or contrarian analysts to build a bear case for me, just to check if there's something I've missed. Loss aversion. The pain of losing is psychologically twice as powerful as the joy of winning. That's why people hold on to losers too long, hoping it'll bounce back, and why they sell winners too early. How I fight it. I remember that every dollar has an opportunity cost. Holding a loser just to get back to even is emotionally satisfying, but financially destructive. Instead, I reframe losses as tuition, paid to the market for lessons that make me sharper. FOMO, fear of missing out. You see a stock running and feel like you're falling behind. You ignore your process, skip your checklist, and jump in. How I fight it. I remind myself that the market is infinite. There will always be another setup. And if I miss one, I'd rather miss clean than enter dirty. My best trades weren't rushed. They came from preparation, not panic. Recency bias. You assume that what just happened will keep happening. If the market drops, you think it'll keep dropping. If a stock surges, you think it'll go to the moon. How I fight it, I zoom out. I look at the big picture. Just because something happened today doesn't mean it defines the next 6 months. I also go back to historical charts, not just recent ones, to remind myself that cycles come and go. Anchoring. You fixate on a previous price. This was $300 before, so it must go back. But price alone doesn't mean anything. What matters is valuation, narrative, and macro context. How I fight it. I focus on where value is now, not where it was. Markets evolve, so should your reference points. I often ask, if I had no history with this stock, would I buy it today at this price? Overconfidence bias. You think you're smarter than the market. You double down without doing the work. You assume your gut is enough. How I fight it. I stay humble. The market doesn't care about ego. I let data and thesis drive size, not emotion. When I've had winning streaks, I step back instead of sizing up. That pause often protects me from a costly correction. The sunk cost fallacy. You've put in so much time or capital into a trade that you feel you have to stay with it, even when the thesis no longer holds. How I fight it. I separate effort from outcome. The market doesn't care how long I held or how much drawdown I've done. If the setup's broken, I move on. Herd mentality. You follow the crowd because it feels safe. If everyone's bullish, you feel confident. If everyone's panicking, you sell without asking why. How I fight it. I zoom out and assess what's actually changed. Macro, liquidity, earnings, guidance. If not, the noise is just that. Noise. I train myself to act when others freeze. The emotional tax of investing. I remember times when these biases collided. During a high volatility period, I found myself checking my phone every 5 minutes, jumping from one feed to another, desperately seeking confirmation that I was right. It was exhausting and unproductive. That's when I realized, if you let your emotions rule, you become your own worst enemy. Markets are designed to test your patience, discipline, and mindset. Red days come with doubt. Green days come with euphoria. I've felt them all, but it's in those moments of extreme emotion that I've learned the most about myself. Every investor has to pay that emotional tax, but how you pay it and what you learn from it is what sets the pros apart from the amateurs. The power of reflection. One of the best tools I've found to master my mind is reflection. I journal my trades, not just the numbers, but my thoughts and feelings around each decision. Was I chasing a stock because of hype? Did I skip my checklist because I was afraid to miss out? This reflection process helps me catch patterns in my behavior. Over time, it's become like a mirror that shows me where I'm improving and where I still need work. Some of my biggest lessons came not from winning trades, but from the trades I executed poorly. Practical strategies for mental mastery. Investing isn't just about data and charts. It's also about managing yourself. I use several simple tools to keep my head clear. Journaling. Writing down my reasons for entering or exiting a trade. Exercise. Physical movement keeps me balanced and reduces stress. Scheduled breaks. Stepping away from the screen helps me see things with fresh eyes. Community. Talking with other investors helps me get perspective and avoid the echo chamber. Mindfulness. Even just 5 minutes of breath work or stillness each morning helps me reset before the chaos of the market. Mental clarity compounds just like capital. Sometimes I'll even talk to my copiers or followers about my thought process. Being transparent keeps me accountable and helps me avoid some of these traps. Pre-trade bias checklist. Before I enter any trade, I run through a quick mental checklist to stay grounded. Am I buying from conviction or from FOMO? Did I follow my process or am I skipping steps? Would I still make this trade if nobody else knew? Have I stress tested the thesis with bear cases? Final thoughts. The best investors aren't the smartest, they're the most self-aware. They know when they're being pulled by emotion, they know how to sit on their hands, and they have systems in place to keep their worst instincts in check. This chapter isn't here to make you feel bad. It's here to help you level up, to understand that your biggest enemy isn't the market, it's you. But that also means your biggest edge is controlling yourself. Master that, and everything else follows. Freedom keys. The market tests your mind more than your strategy. Emotional discipline is what separates consistent winners from the rest. Biases are invisible until you name them. Journaling and reflection turn blind spots into breakthroughs. Process over impulse. Acting on a plan beats reacting to emotion every single time. Loss aversion, FOMO, and overconfidence are the real portfolio killers. Learn to manage your inner world before trying to master the market. Mental clarity compounds like capital. A calm, focused investor will always outperform a frantic one over time. You don't need to be fearless, just self-aware. The investor who controls their behavior controls their outcome. Call to action. Take a few minutes to reflect on which of these biases has tripped you up in the past. Write them down, along with one action you can take to counter them the next time they appear. The more self-aware you become, the stronger and more resilient you'll be as an investor. Because in the end, your mind is your greatest asset, or your greatest liability. Make it your ally and the market becomes your playground. In the next chapter, I'll show you how to design your own pathone that aligns with your goals, personality, and risk tolerance so you can build wealth with confidence and clarity. Chapter 13. Designing your own path. How to craft a strategy that aligns with your goals and risk tolerance. When I first started investing, I thought success meant copying the experts. I watched what hedge funds were buying. I mimicked portfolios I found online. I assumed that if I just followed someone else's blueprint, I'd end up with their results. But over time, I learned a powerful truth. The best results come when your strategy matches who you are. Your investing style is like a fingerprint. It should reflect your psychology, your time horizon, your goals, and your emotional tolerance for risk. Without that alignment, even the best strategies will crumble under pressure. You'll chase trades that don't feel right. You'll hold positions that keep you up at night. And when the market turns against you, you'll bail. Not because the strategy failed, but because it wasn't yours to begin with. Designing your own path means more than finding what works. It means building something that works for you. The power of personalization. Imagine two investors. One is 25, working full-time, and has a 30-year investment horizon. The other is 58, nearing retirement, and needs to preserve wealth while generating income. Should they use the same portfolio strategy? Absolutely not. The 25-year-old can afford to take calculated risks, stomach drawdowns, and swing for growth. That same volatility might derail the 58-year-old's entire plan. And yet I've seen this mistake happen again and again. People adopt strategies that don't fit their lives. They see someone crushing it in high-growth names and load up, without realizing that their own goals, age, or risk tolerance don't support that kind of exposure. That's how investors get trapped, not by the market, but by following a path that was never theirs to begin with. Start with self-awareness. Before you open a chart, before you research a stock, pause and ask the deeper questions. Why am I investing in the first place? What does financial success actually look like for me? How much volatility can I truly handle? Do I want to retire early, buy freedom, or build generational wealth? These answers form the roots of your investing strategy. They shape how aggressive you can be, how concentrated your portfolio should look, and what kind of drawdowns you're willing to endure. I started investing because I wanted freedom, the ability to live life on my terms, not chained to a clock. That goal shaped every decision I made. It's why I embraced long-term thinking, why I focused on disruptive innovation, and why I built a concentrated portfolio with asymmetric upside. Build your personal framework. I always think of a strategy like a pyramid. At the base, your unshakable beliefs, your North Star. In the middle, the tactics you use, your sizing, your sector focus, your time horizon. At the top, your flexibility, how you adapt to markets without losing your core. Here's how you can start crafting that pyramid. 1. Define your investing identity. Are you a long-term holder? A swing trader? A thematic investor? A dividend seeker? You don't have to label yourself, but you do need clarity. For me, I'm a long-term thematic investor with a focus on macro, narratives, and asymmetric upside. I don't chase short-term trades. I don't over-diversify. I position early in megatrends and I size up when conviction aligns with macro tailwinds. Others thrive on trading momentum or hunting value. That's great. But if you're a calm, long-term thinker trying to mimic a day trader's playbook, you'll constantly feel out of rhythm. Which two? Decide on concentration versus diversification. There's no one-size-fits-all here. I prefer to go deep, to know a few companies incredibly well, size them accordingly, and hold through volatility. But others prefer to spread risk across sectors and strategies. Ask yourself, do I sleep better with 5 core positions I deeply understand? Or does having 20 positions across sectors help me stay steady? The answer will shape how you manage risk and how you manage your emotions. 3. Create your playbook rules. Every investor needs a system, even a simple one. These are the rules that guide your behavior when the market gets noisy. When do I buy? After a 20% dip? At technical support? After earnings beats? When do I sell or trim? If the narrative breaks? After a 2x move? When portfolio weight exceeds 20%? How do I manage risk? Using stop losses, portfolio limits, dry powder for dips? When I invest, I use a mix of macro awareness, technical timing, and narrative conviction. I scale in. I don't go all in at once. I trim euphoric rallies. I write down my thesis and revisit it quarterly. Your system doesn't need to be complex. It needs to be consistent. Marry macro with personalization. Even when you design your own path, don't ignore the world around you. Macro matters. Liquidity matters. Policy matters. If rates are rising, liquidity is contracting, or geopolitical risk is flaring. Those things affect every portfolio, no matter how personal it is. I always ask, is the environment risk on or risk off? Is liquidity expanding or tightening? What sectors are benefiting from fiscal support or global tailwinds? Even if you love a company, you don't have to size it the same way in every cycle. That's where macro alignment meets personal flexibility. I remember a time when my conviction in Tesla was sky high, but macro conditions turned against high growth. Instead of panicking, I trimmed exposure to rebalance risk. That wasn't about fear, it was about staying aligned. Investor archetypes, 3 different paths. Investor A, Sarah, 27, software engineer. Comfortable with risk, focuses on high conviction growth stocks and emerging tech, uses a concentrated portfolio, and actively adds on dips. Investor B, James, 42, small business owner. Invests for early retirement, combines ETFs, dividend growth stocks, and a few thematic plays, balanced and diversified with a medium-term focus. Investor C, Linda, 60, recently retired. Prioritizes capital preservation and income. Allocates to dividend stocks, REITs, and short-term bonds. Avoids high volatility names. Each of these investors has a strategy that reflects their life stage, goals, and emotional tolerance. None is better. They're just aligned. Make it visual. One trick I've used for years is mapping my portfolio visually, with allocation heat maps, conviction ratings, and macro alignment scores. Seeing your strategy on one page helps you spot drift. It keeps your decisions intentional. It shows you when conviction and sizing are misaligned. You can build this in a spreadsheet or even sketch it on paper. Just make sure you're not flying blind. Design requires clarity. Learn by doing. Your path won't be perfect from day one. It'll evolve, just like you will. The best way to refine your strategy is to practice. Start with small positions. Track your reasoning. Write down what worked and what didn't. Every trade is feedback. Every journal entry is data. Over time, you'll start to notice patterns in yourself, where you act from clarity and where emotion sneaks in. A quote to remember. Bruce Lee says, absorb what is useful, discard what is not, add what is uniquely your own. That's investing in a nutshell. Take what resonates, drop what doesn't, and refine the rest into something that fits you like a glove. Try this, your personal strategy audit. List your top 5 current holdings. Rate each one, 1 in 10, on your conviction, macro alignment, and emotional comfort. If a holding scores low across the board, why are you still in it? Now write a short paragraph. What is your investing identity? What rules guide your actions? Do this every 3 to 6 months. Let your answers evolve with you. Final thoughts. Designing your own path isn't about reinventing the wheel. It's about taking what resonates from others and shaping it to fit your goals, beliefs, and bandwidth. It's about creating a system that lets you sleep at night and act with confidence, even when the market is loud. And most of all, it's about owning your journey. You don't need to trade like a hedge fund. You don't need to predict the future. You just need a process that's honest, intentional, and repeatable. Because when you trust your own system, you stop reacting and you start compounding. Freedom, keys. There is no one-size-fits-all strategy. Your goals, risk tolerance, and personality should shape your approach. Self-awareness is your greatest asset. When you know who you are, you stop copying and start compounding. Design beats default. A strategy built with intention will always outperform one built on guesswork. Conviction feels different when it's yours. When your plan reflects your values, you're more likely to stick with it through volatility. A portfolio is a reflection of identity. It should fit your life, not someone else's version of success. Adaptation is part of the design. Your path will evolve. Let your strategy grow with you. Call to action. Take 30 minutes today and create your own investor blueprint. Write it down. What's your why? What's your risk tolerance? How do you define conviction? What are your buy-sell rules? How will you track and review your performance? This isn't a one-time exercise. Revisit it every quarter. Refine it as you evolve. Let it become your compass, the thing that keeps you steady when the markets test your patience. Because in the end, your strategy doesn't need to be perfect. It just needs to be yours. And once it is, that's when everything changes. In the final chapter, I'll bring it all together and show you how we can grow together by turning this philosophy into real-world action. Chapter 14. Let's grow together. A final word on building wealth, staying connected, and what comes next. Writing this book wasn't about self-promotion. It was about sharing a roadmap, a blueprint for anyone who's ever felt stuck, overwhelmed, or convinced that building real wealth is reserved for the privileged few. It's not. I've given you everything I know, how I started with nothing, the frameworks that guide me, the principles that keep me grounded, and the mindset shifts that have transformed my life. If this book has helped you think differently, sparked a curiosity you didn't know you had, or given you just one tool to level up, then it's done its job. But here's the truth. This is just the beginning. Every day I'm still on this journey, refining, learning, and adapting. And I share that journey openly on eToro, where I trade under the username Tonishi. You'll find live positions, real-time analysis, and my honest reflections. Not just when things are going well, but also when the market tests every fiber of my discipline. Because that's real investing. eToro is a regulated platform where you can follow investors, learn by watching, and, if it suits you, copy portfolios automatically. I'm not here to convince you to copy me. I'm here to invite you to think bigger, to show you that, with the right process, the right mindset, and a willingness to learn, you can build wealth in a way that feels authentic and sustainable. Maybe that means following my updates to see how I manage risk. Maybe it means copying my trades to learn by doing. Or maybe it just means taking what you've learned in these pages and forging your own path with renewed confidence. My mission isn't just to grow my own portfolio. It's to help others break free from the 9-to-5 grind and build a life on their terms. To empower more people to achieve financial freedom, not by chasing hype or luck, but by applying a process that works. Because real wealth isn't about a single lucky trade. It's about showing up every day, learning, evolving, and taking consistent, disciplined action. I want this book to be more than just words on a page. I want it to be the spark that ignites a new chapter in your life. One where you feel confident, empowered, and in control of your financial future. If you've read this far, I know you're serious about making a change. I'm here to remind you, you have everything you need, the frameworks, the tools, the mindset. Now it's up to you to put them into action. If I could tell you one thing, it would be this. You're closer than you think. Most people never start, but you did. By picking up this book, by reading this far, by choosing to think differently. You don't need to be perfect. You just need to stay in the game. I share my investing journey openly on eToro Tonishi, not just for followers, but for learners. If seeing a real portfolio in action helps you sharpen your own edge, you're welcome to follow along. Brent, your turn. Take 5 minutes right now and write down one goal this book inspired you to pursue. Is it starting your first investment? Building a long-term strategy? Finally getting serious about financial freedom? Write it down. Come back to it in 6 months. Let this moment be the one where everything shifted. Because the best time to start was yesterday. The second best is right now. If you're enjoying The Freedom Investor, you can connect with Tony and get his latest market insights at thefreedominvestor.com. That's where he shares portfolio updates, new blog posts, and his exclusive quarterly newsletter packed with deep macro analysis and the stocks he's watching next. Bonus. Chapter 1. Manifesting Wealth. How Mindset, Manifestation, and Self-Belief Shape My Journey. Most people get manifestation wrong. They think it's about chanting affirmations and waiting for the universe to magically deliver results. They treat it like a wish list, not a way of life. But in my experience, manifestation doesn't work unless you do. Manifesting wealth for me has never been about sitting back and waiting for success to appear. It's about reshaping the way I see myself, acting with purpose, aligning my habits with my vision, and creating the emotional and mental environment for wealth to take root. Yes, thoughts are powerful, but they are just the beginning. The real transformation happens when those thoughts become identity. Manifesting wealth isn't about faking it until you make it. It's about living it until you become it. It's about believing at your core that you are already on the path to wealth, and then letting that belief shape your habits, your decisions, and your daily life. Belief is the foundation. Let me give you an example. Imagine I told you that you've already won $1 million in the lottery, but you can't withdraw it for another 10 years. How would that change the way you live today? Would you start to walk with more confidence? Would you stress less about the little things? Would you begin planning your future differently, knowing that the money is already yours, just waiting for you to claim it? That's what manifestation is. It's the same principle. You have to know deep down that the life you want is already yours. You just haven't arrived at the withdrawal date yet. You need to act like the money, the freedom, the abundance is already there, because in many ways it is. And when you show up in the world with that level of belief and energy, the results begin to follow. When I first started investing, I didn't have a 7-figure portfolio. I didn't have fancy tools or insider connections. But I had one thing: belief. I believed that I was already wealthy, even when my bank account didn't reflect it yet. This wasn't some delusion or ego trip. It was a mindset shift. I treated my time like it was worth thousands of dollars. Every minute was valuable. Every decision counted. I acted like a millionaire, not by spending recklessly, but by valuing my time, investing in my growth, and building habits that would set me up for the future I envisioned. And over time, that belief became reality. Your brain can't tell the difference, and why that matters. One of the most powerful insights I've learned comes from neuroscience, particularly from the work of Joe Dispenza. He teaches that the brain doesn't know the difference between what's real and what's vividly imagined. When you visualize something with enough detail and emotion, your brain fires the same neural pathways as if you were actually experiencing it. This is why belief is so powerful. When you believe you're already wealthy, you start to program your mind and your body to act in ways that align with that belief. It's not just about thinking positive thoughts. It's about changing your identity at the deepest level. Dr. Joe Dispenza says to change is to think greater than your environment. When you think, act, and feel as though you're already living your dream life, you begin to attract opportunities that align with that identity. That's not magic. That's neuroscience and energy at work. The energy you radiate shapes the reality you experience. If you live in a state of scarcity and fear, you attract more scarcity and fear. But if you live in a state of gratitude, abundance, and possibility, you attract opportunities that match that frequency. Early in my investing journey, I started every day with a mindset of gratitude. Even when my account was small, I thanked the universe and myself for the opportunities I was creating. That energy gave me the resilience to handle setbacks and the optimism to spot opportunities others missed. Dan Locke's RX8, A Lesson in Manifestation. I'm reminded of a story from Dan Locke, an influencer on YouTube who inspired me early in my journey. He shared that his dream car was a Mazda RX-8. He visualized it constantly, not just imagining the car, but sitting in the driver's seat, feeling the leather, smelling the new car scent. He even went to the dealership to test drive it, immersing himself in the experience. When he finally bought the car and drove it home, he didn't feel the rush of excitement most people expect. Why? Because he had lived that moment thousands of times in his mind. To him, it just felt like another day. That's how you truly manifest something, by making it so real in your mind that when it shows up in reality, it feels like the natural next step. My first million, a lesson in identity. I had a similar experience when I hit my first $1 million portfolio in 2020. It wasn't sudden. It was the result of years of mental preparation and disciplined action. I had visualized that moment countless times. Not just the number on the screen, but the feeling of peace, clarity, and alignment that would come with it. And when it finally happened, when my account hit 7 figures, I didn't jump for joy or run to celebrate. It felt normal, not because I didn't care, but because mentally and emotionally, I was already there. I had already lived in that version of myself for so long that the external confirmation was just catching up to my inner world. One of the books that shaped this part of my journey was Think and Grow Rich by Napoleon Hill. Early on, I misunderstood the title. I thought it meant think and grow rich, as in money. But over time, I came to realize what it really means. Think and grow rich inside. Your thoughts, your identity, your internal belief system. That's where the real wealth begins. Before I ever made $1 million, I had to become the kind of person who believed it was inevitable. That mindset didn't just inspire me, it changed me. By the time I saw the number, I was already thinking like a millionaire. I was already acting like one, protecting my time, seeking high-leverage opportunities, and managing risk with clarity and composure. That's what made it feel so natural. The number didn't make me feel wealthy. The mindset did, long before the numbers ever showed up. That's the power of manifesting wealth. It's not about wishful thinking. It's about aligning your beliefs, habits, and decisions with the reality you want to create. Living the millionaire mindset. Manifesting wealth isn't just about thoughts. It's about actions. When you truly believe that you are already on the path to wealth, you naturally start living like it. You make decisions that align with abundance, not fear. Invest your time and money in opportunities that match your goals. Surround yourself with people who support and challenge you to grow. Prioritize learning and self-development, knowing that every skill you gain is an investment in your future. One of the best pieces of advice I ever received was, live like the person you want to become. For me, that meant protecting my time, treating it as my most valuable asset, saying no to distractions that didn't move me forward, investing consistently, even when the amounts felt small, trusting that every smart decision compounded over time. Practical steps to manifest wealth. If you want to manifest wealth, start with belief, but back it up with action. Here's how I've integrated this mindset into my life. 1. Define wealth for yourself. 2. Is it financial freedom? Time with family? Freedom from a 9 to 5? Get clear. 3. Shift your identity. 4. See yourself as someone who creates wealth, not just someone who dreams about it. Visualize yourself as already wealthy. What does that look and feel like? 5. Take daily aligned actions. 6. Every day do something, however small, that aligns with your wealthy mindset. 7. Value your time like a millionaire. 8. Would a millionaire waste hours on things that don't move them forward? Treat your time like it's your most precious asset. 9. Stay grateful and radiate abundance. 10. When you're grateful, you're telling the universe you're ready for more. Gratitude amplifies abundance. 11. Rewire your brain. 12. Practice daily visualization. Joe Dispenza's meditations and guided exercises are a powerful way to teach your brain that wealth is your reality. Why this matters. When I look back at my journey, I see that wealth started in my mind long before it showed up in my account. That's why I emphasize this so much, because it's the piece most people skip. They chase hot stocks, meme coins, and get-rich-quick schemes. But they never stop to ask, do I truly believe I can be wealthy? Am I living like it already? If the answer is no, that's where you start. Reframing the skepticism. Some people hear the word manifestation and tune out. I get it. I used to think it sounded like fluff too. But here's what changed everything for me. Understanding the science behind it. This isn't magic. It's biology. When you hold a new identity long enough through visualization and emotion, your brain begins to prune old neural pathways and reinforce new ones. That's how lasting change happens. It's called neuroplasticity. You're not just thinking differently, you're rewiring your brain. And when your brain changes, your behavior changes. That's what leads to new results. There's a saying I've come to believe deeply. You can't fix a problem with the same mindset that created it. To truly change your financial reality, you first have to change how you think, how you see yourself, and how you show up every day. Your environment doesn't shift until your mindset does. And once your mindset shifts, everything else begins to align. A glimpse at my old mindset. There was a time when I thought manifestation was nonsense. I was stressed, reactive, constantly chasing wins but never feeling grounded. I thought hustling harder was the only way out. But once I leaned into this new mindset, not just dreaming about wealth but acting like I was already living it, things shifted. My decisions improved, my confidence grew. I stopped chasing and started aligning. And eventually my reality caught up with the identity I had already built in my mind. Final thoughts. Manifesting wealth isn't about magic. It's about aligning your beliefs with your actions and living every day as if you already have the wealth you desire. Start living like the person you want to become. Protect your time. Make decisions from a place of strength, not scarcity, and trust that every step you take, every smart choice you make will compound over time. Because when your belief aligns with your energy, that's when real wealth shows up and your life transforms from the inside out. Call to action. Take 5 minutes today to sit in silence, close your eyes, and visualize your wealthy self. Where are you? What are you doing? How do you feel? Then write down one action you can take this week to live in alignment with that version of you. This is how manifestation becomes momentum, not through wishing, but through living like it's already real. Bonus. Chapter 2. Lessons learned. The hard truths, big wins, and costly mistakes that shape my investing journey. Every investor's journey is filled with lessons. Some learn the easy way, most learn the hard way, and markets are humbling. They don't care about your ego, your intentions, or your timeline. They reward those who are prepared, patient, and adaptable, and punish those who let emotion or arrogance drive their decisions. Over the years, I've made my share of mistakes. I've chased hype, mistimed trades, oversized positions, and let fear push me out of great companies. But I've also experienced the upside of sticking to a process, staying disciplined, and letting time do the heavy lifting. Each mistake, each win, each loss, they've all been teachers. That's the beautiful and brutal truth about investing. It's never just about money. It's about mindset. It's about who you become in the process. If there's one thing I know for sure, it's this. Success leaves clues, but only if you pay attention. Here are some of the most important lessons that have shaped my approach to investing, my mindset, and, ultimately, my life. Lesson 1. You are your greatest asset. Books, mentors, and data are important. But at the end of the day, your mindset, resilience, and discipline are what carry you through market cycles. I didn't grow up with a financial background or a trust fund. Everything I built came from the belief that I could figure it out, that I could learn, adapt, and grow. That mindset has carried me through every drawdown, every market correction, and every moment of doubt. When I faced the crypto crash of 2017, I didn't have much experience navigating an 80% drawdown. But I learned that if I didn't invest in myself, in my knowledge, in my emotional resilience, I'd keep repeating the same mistakes. That's why I emphasize reading, reflecting, and constantly upgrading your thinking. Because at the end of the day, the markets will test you. And your greatest edge is the investor you become along the way. Lesson 2. Emotions are the enemy of returns. Fear and greed are powerful forces. They push you to sell too early or buy too late. One of the hardest lessons I learned was to separate my emotions from my investments. I've felt the panic of red days, the urge to hit sell just to make the pain stop. But over time, I developed the discipline to pause, step back and ask, is my thesis still intact? Is this volatility or a real shift in fundamentals? Once I trained myself to act based on process rather than emotion, my performance improved. Because emotion-based investing isn't investing, it's reacting. Lesson 3. Risk management is everything. Even the best thesis can fail. That's why I always size my positions carefully and respect my risk. Early on, I was guilty of going all in on what I thought was a sure thing. Sometimes it worked. But when it didn't, the losses were brutal. I remember one trade in a small cap growth stock where I had too much conviction too early. The thesis made sense, but the execution was poor and the position sank 40% before I admitted I was wrong. That experience taught me a truth I never forgot. Even the best idea can be undone by poor risk management. Today, I size my positions according to conviction, but always within the context of total portfolio risk. That allows me to ride winners and survive losers. Lesson 4. Narrative drives price, but fundamentals win long-term seeing. I've made some of my best trades by spotting emerging narratives early. AI, EVs, renewable energy. Those themes drove incredible returns. But I've also learned that narrative alone can't sustain price forever. Take Tesla, for example. I've held through volatility, not because the hype was strong, but because the fundamentals, technology, execution, vision, kept progressing. When narrative and fundamentals align, magic happens. But when narrative runs ahead of substance, things can unravel fast. To our lesson 5, patience is a superpower. The market rewards those who can sit tight. I've had trades where I waited months, even years for the thesis to play out. But when it did, the payoff was worth every minute of waiting. In 2022, when tech stocks were under pressure, I held my core positions like Nvidia and Tesla. It wasn't easy watching daily swings, but I reminded myself the market is a voting machine in the short term and a weighing machine in the long term. Staying patient allowed me to capture the full arc of the story. Lesson 6. Don't underestimate compounding. Compounding isn't just for capital, it's for knowledge too. When I started investing, I wanted the 10x wins. But as I matured, I realized that small, consistent gains, reinvested with discipline, created real wealth. The same is true for learning. Every book, every podcast, every conversation with a mentor added layers to my understanding. Over time, those small insights compounded into a powerful decision-making framework. Compounding rewards the patient, in money and in mindset. Lesson 7. Learn from every loss. Every investor takes losses. What matters is what you do next. When a trade goes south, I no longer beat myself up. I ask, was it a bad decision or just a bad outcome? Did I follow my process? What can I take into the next trade? Losses are tuition. Expensive, yes, but invaluable if you extract the lesson. Lesson 8. The best investment is in yourself. Yes, stocks matter. Portfolios matter. But you are the asset that compounds the most. Every time I invested in myself, learning a new skill, studying market cycles, understanding macro trends, it paid dividends. I've spent thousands on courses, books, and mentorships. Not all of them paid off directly, but each one added something to my tool belt. And over time, those tools helped me build not just wealth, but confidence, clarity, and conviction. Lesson 9. The market is always smarter than you think. No matter how much you learn, the market will always find a way to surprise you. It doesn't care how confident you are or how compelling your thesis sounds. That's why the best investors aren't the ones who are always right. They're the ones who stay open, adaptable, and willing to evolve. I've learned to hold my beliefs loosely and my process tightly. It's okay to be wrong. What matters is how quickly you recognize it and how well you protect your capital. Humility in this game isn't a weakness. It's a survival skill. Final thoughts. These lessons didn't come from a textbook. They came from real-world experience, from bear markets and bull runs, from trades that soared and trades that crashed. If there's one thing I hope you take from this chapter, it's that investing is as much about who you become as it is about what you buy. Stay humble, stay patient, keep learning, because the journey never stops and every step shapes the investor you'll become. Because, in the end, the best trades are the ones that build you. Call to action. Pick one lesson from this chapter that resonated with you the most, and commit to applying it in the next 7 days. Whether it's journaling your trades, refining your risk management rules, or simply reading a chapter from a great investing book, take action. Learning is only the first step. Growth comes from applying it. Write it down, schedule it, and do it. Because real transformation happens when knowledge turns into action. If you're enjoying The Freedom Investor, you can connect with Tony and get his latest market insights at thefreedominvestor.com. That's where he shares portfolio updates, new blog posts, and his exclusive quarterly newsletter packed with deep macro analysis and the stocks he's watching next. Bonus. Chapter 3. My eToro Playbook. How I manage my portfolio, think about trades, and make decisions in real time. Trading on eToro has transformed the way I invest and the way I share my journey with others. It's not just a brokerage. It's the backbone of my daily routine, my strategy execution, and my ability to empower others through transparency. Before I joined eToro, investing felt like a solitary mission. You do your research, place your trades, and track your progress quietly. But once I became part of the eToro community, something changed. I realized that investing doesn't have to be isolated. It can be collaborative, transparent, and even social. I could trade with purpose and bring others along on the journey with me. That shift opened up a whole new world. Suddenly, my portfolio wasn't just for me. It became a platform to lead, teach, and grow a community of investors who wanted to do better. Not everyone has the time, confidence, or access to build their own strategy from scratch. Through eToro, I could offer my process, not as a shortcut, but as a real-time example of long-term thinking and action. In this chapter, I want to pull back the curtain on how I actually manage my portfolio in real time. Not hypotheticals, but the exact process I use day in and day out. You'll see how I approach risk, make allocation decisions, determine when to trim or double down, and stay grounded in a market full of noise. Whether you're a seasoned investor, a curious beginner, or someone who's been copying me for a while, my goal is to show you the engine behind the performance. The mindset, systems, and structure that keep everything aligned with my long-term goals. This isn't about being perfect. It's about being consistent, transparent, and accountable. That's what eToro enables, and that's why I'm proud to call it home. Why eToro? When I started investing in eToro, I wasn't just looking for a brokerage. I was looking for a platform that aligned with my values: transparency, education, and community. Most traditional brokers just give you a place to buy and sell. eToro gives you a place to build, to learn, and to lead. Every trade I make is visible. Every return is tracked. Every copier shares the same performance I do. No hidden fees, no secret portfolios. That level of accountability isn't just rare. It's empowering. It keeps me sharp. It keeps me disciplined. And most importantly, it builds trust with those who follow me. Unlike isolated investing apps, eToro functions more like a social network for investors. You don't just see tickers, you see thought processes. You don't just follow trades, you follow people. That dynamic has created a powerful ecosystem of learning and shared success. eToro's IPO, a new chapter of trust. The recent IPO of eToro marked a huge step forward, not just for the company, but for everyone on the platform. Going public means more transparency, more regulatory oversight, and more accountability. As someone who values transparency in everything I do, this move reassured me. It showed that eToro is committed to long-term growth and to creating a professional, trustworthy environment for investors and copiers alike. My mission on eToro. Yes, I want to grow my portfolio. But just as importantly, I want to empower others to grow theirs. I believe that true wealth isn't just about money, it's about mindset, education, and shared success. My mission on eToro is to build a community where people don't just copy trades, but grow into confident, capable investors in their own right. I want to be more than just a portfolio people follow. I want to be a catalyst for transformation. I want someone who starts with zero knowledge to learn, grow, and eventually lead. That's the ripple effect I'm aiming for. Through transparency, consistency, and education, I hope to inspire a shift from fear to confidence, from scarcity to abundance, from guessing to understanding. I want more people to realize that building wealth isn't reserved for the few. It's possible for anyone who commits to the process. We rise by lifting others. If my journey can shorten someone else's learning curve, that's a win. If my transparency can help someone invest with more confidence, that's value. If my playbook can be copied, improved, and multiplied, then we all grow together. The power of copy trading. Copy trading is one of the most powerful features eToro offers. It democratizes access to professional-level strategies, allowing everyday investors to follow experienced traders in real time. One important thing to understand, when you copy a trader on eToro, you're always in full control of your funds. You're not sending your money to the trader or handing it over to be managed. Your account simply mirrors their trades automatically, in real time. It's your capital, your account, fully accessible and secure at all times. I never have access to your funds. What you're doing is following my strategy, not giving me control. That's a critical distinction, and one of the key reasons why copy trading on eToro is so safe and transparent. It's not about blindly copying. It's about learning through action. You get to see not just what I buy, but why I buy it. You see my entries, my exits, and my reasoning. And most importantly, you experience the market through the lens of a structured process, with full transparency every step of the way. Unlike traditional fund managers who charge multiple layers of fees, copying on eToro is completely free. No management fees, no performance fees, just aligned incentives. I grow when you grow. How I build my portfolio. My portfolio is built around a simple but powerful framework. Macro-driven strategy. I always start with the macro. Is the Fed easing or tightening? What's happening with global liquidity, interest rates, and fiscal policy? Narrative-led positioning. I focus on secular trends like AI, clean energy, digital infrastructure, and space tech. I want exposure to the future. Conviction-based sizing. Big ideas get big positions. I size based on long-term conviction, not short-term volatility. Barbell balance. I combine high-conviction core holdings with smaller, high-risk tactical trades. Risk-adjusted allocation. Every position fits within an overall portfolio design that prioritizes drawdown control and volatility management. My daily, weekly routine. Here's what my routine typically looks like. Daily. Check global macro news, liquidity conditions, bond yields. Review price action in my core holdings. Monitor risk score and portfolio drawdown. Weekly. Deep dive into earnings reports, sector data, and fund flows. Reassess thesis alignment for all major positions. Share commentary and updates with my copiers. I treat eToro like a professional dashboard. Every decision is logged, visible, and accountable. Managing risk for me and my copiers. Risk management is everything, especially when others are copying my moves. I use diversified allocation across non-correlated assets, adjusted depending on market conditions to reduce volatility and protect capital, position sizing aligned with the volatility and conviction, mental stop losses and scenario-based risk reviews. I don't use automatic stop losses, but I always have predefined exit criteria in mind before entering a trade. This helps me stay disciplined while allowing for strategic flexibility. I don't aim for constant fireworks. I aim for sustainable compounding. I want my portfolio to be resilient, something I can be proud of 10 years from now. What I look for in a stock: before I enter any trade, I ask, what's the macro context? What secular trend does this align with? Does the company have an edge, a moat, or a mission? Is leadership visionary? Are financials scalable? My biggest positions, like Tesla, Palantir, and NVIDIA, all meet these criteria. They're not just stocks, they're stories. I'm not trading tickers. I'm backing missions I believe in, communicating with copiers. I view communication as part of my responsibility. I regularly post market updates, trade explanations, risk alerts, thesis breakdowns. My goal is not to hype, but to educate, to build trust through clarity. Copiers aren't just mirroring my trades. They're on a learning journey alongside me, staying consistent and disciplined. I don't chase, I don't react, I execute. Markets are noisy, but the process is quiet and powerful. I stay consistent with my strategy and always play the long game. I know that my results don't come from luck or timing. They come from repeatable systems and disciplined thinking. Consistency builds confidence, and that confidence is what allows copiers to stay the course during volatile times. Debunking copy trading myths. Copy trading is one of the most misunderstood tools in investing. Many people assume it's a shortcut or a way to avoid doing the work, but in reality, it's a structured learning mechanism and a powerful vehicle for compounding wealth when used with the right expectations. Here's what it's not: a get-rich-quick scheme, a way to eliminate all risk, a substitute for understanding your investments. Here's what it is: a way to learn by observing a live, transparent strategy, a bridge for beginners who want to start with structure, a method to align your portfolio with a trusted process while developing your own edge. Copying is the entry point, not the end point. It's a way to level up while staying grounded in a proven system. Final thoughts. eToro isn't just where I trade, it's where I lead. It's the platform that has helped me scale my strategy and reach more people. But more importantly, it's the platform that lets me empower others to build and grow their own portfolios with confidence. If you're serious about building wealth with transparency, discipline, and a process you can trust, I invite you to follow along. Not because I have all the answers, but because I've walked the path and I'm still walking it. And now I'm walking it with thousands of others. Want to see my process in action? Whether you're here to learn, follow, or build your own path, you're welcome to join the journey. Follow me on eToro, eToro.com. Check my Bullaware fact sheet for the latest stats. Bullaware.com, fact sheet, Tonishai. Bonus. Chapter 4. FAQs and Common Misconceptions. Real questions from real investors. Answer with honesty and clarity. Every time I meet a new copier or connect with someone curious about investing, I get a flood of questions. And I love that. It's a sign that people are engaged, curious, and taking charge of their financial future. Over the years, I've realized that answering these questions isn't just about giving advice. It's about building a community of informed, confident investors who understand that investing is a journey, not a shortcut. I've had countless conversations where a single question, like, how much should I copy you with, has led to discussions that shifted a copier's entire mindset about risk, strategy, and long-term thinking. These moments are some of the most rewarding parts of being an investor who shares openly. That's why I wrote this chapter, to give you a roadmap, clear up the noise, and help you navigate this path with confidence and clarity. I want you to know that investing is personal. There's no one-size-fits-all. These questions and my answers are here to guide you, but ultimately it's your journey to shape. Getting started. How much should I copy you with? This is easily the most common question I get. The answer? It depends on what you're comfortable with. There's no magic number, no one-size-fits-all answer. Also, some people feel confident starting with a small amount to get a feel for my strategy before committing more. Others might allocate a larger portion of their portfolio if they're aligned with my approach and risk tolerance. The key is that you need to be able to sleep at night with your allocation. I never want anyone to invest more than they can emotionally or financially handle. If a drawdown happens, and they do, you don't want to panic because you've overextended yourself. What's the best time to start copying? The best time to copy is when you feel confident that my strategy aligns with your goals and risk profile. There's no perfect entry point. Markets will always have volatility, and waiting for the perfect time can mean missing opportunities. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. If you believe in the long-term approach I've outlined in this book, then the sooner you start, the sooner you benefit from compounding. Do I need a lot of money to get started? Oh, no. One of the best things about investing today is that technology has removed most of the barriers to entry. With fractional shares, you can start with just a few $100s. What matters most is starting early, because compounding rewards time more than size. Are there any fees for copying you? No, eToro doesn't charge you to copy me. You'll get the same trades I make with the same entries and exits, at no extra cost. It's one of the most cost-effective ways to learn and grow your portfolio alongside a full-time investor. Strategy risk. What makes you different from other investors on eToro? I focus on high-conviction, macro-backed investments that align with long-term secular trends. I'm not here for quick trades or hype cycles. I invest in companies I believe will shape the next decade. Everything I do is based on a transparent process I openly share, so copiers can understand the why behind each move, not just the what. Should I copy open trades or wait for a fresh month? When you copy open trades, you're buying at current prices, not necessarily at the price I originally entered. And that's completely okay. If I'm still holding a position, it means I still believe in its upside. If you're unsure, you can always copy with equity protection to ease into it. Can I lose money? Yes. All investments carry risk. Even well-researched positions experience drawdowns. What matters is how risk is managed. I can't promise there won't be losses, but I can promise I use the same disciplined process for my money as I do for yours. Do you use leverage? No, I don't use leverage. I invest only with capital I'm comfortable having in the market. My goal is to sleep well at night, knowing I'll never be forced to sell just because of a margin call. My strategy is built to handle volatility, not avoid it. Do you short the market? No, I don't short the market. My philosophy is rooted in optimism. I'd rather invest in innovation, growth in the future than bet on decline. I want markets to rise because that means more people are prospering. Shorting doesn't align with my values or approach. What if I'm scared of volatility? Volatility is the price of admission for long-term returns. That doesn't mean it's easy. I've had days when my portfolio was deep in the red, but I remind myself that volatility is where opportunity lives. If your thesis is solid and you size your positions wisely, volatility becomes a tool, not a threat. Do I need to monitor my copy account daily? No, and I'd actually recommend that you don't. My strategy is based on macro shifts and long-term trends, not day-to-day news. Watching every tick can lead to emotional decisions. Trust the process and let time do the heavy lifting. Do you ever invest in bonds or cash? Yes, selectively. I hold cash when markets feel overheated or when I'm waiting for a strong opportunity. Bonds can help with balance, but in the current environment, I prefer equities that align with my long-term growth themes. Or process philosophy. What if I don't understand every trade you make? That's completely normal. You're not expected to know everything on day one. I always share my reasoning behind each move, and over time you'll start to see the full strategy come together. Copying is also a way to learn by osmosis, seeing what works in real time. One, how often do you trade? In, not often. I move when the macro backdrop changes, when narratives shift, or when a key technical level triggers action. Some weeks I won't make a single move, and that's intentional. Patience is part of the edge. Do you ever take profits? Yes, I trim when positions grow too large or when the narrative changes. I don't try to time the top, but I do rebalance to manage risk and keep the portfolio healthy. No. What's the best way to learn about investing? Start by learning from people who've actually done it. Books, podcasts, and YouTube are great. Just make sure the person you're learning from has skin in the game. And start small. Use small positions to test ideas, build confidence, and learn through experience. How do I know when to buy or sell? My decisions come from a mix of macro environment, liquidity, rates, Fed policy, fundamentals, earnings growth, innovation potential, narrative shifts, secular trends and sentiment, technicals, entry points, support/resistance. But more than anything, I stick to process. Perfect timing is a myth. I build in stages and I trim or adjust as narratives evolve. Why do you focus so much on macro? Because macro drives markets. Liquidity, interest rates, and fiscal policy create the conditions that move capital. If you want to ride the wave, you need to understand the tide. Isn't investing just about buying low and selling high? In theory, yes. In practice, it's much harder. Cheap stocks can stay cheap and expensive ones can keep running. That's why I focus on the why behind price action. Macro, narrative, psychology, not just the numbers. Mindset growth. What are the mindset misconceptions that hold people back? One of the biggest barriers in investing isn't knowledge, it's mindset. Here are some limiting beliefs I hear often. I'm not good with money. Investing is only for rich people. I always mess things up. I'll probably lose everything. These are just stories, not facts. Every successful investor started somewhere. What matters most is staying consistent, learning through mistakes, and trusting yourself to grow. Do you ever make mistakes? All the time. I've entered trades too early, held on too long, and misread macro signals. But mistakes are part of the game. What matters is learning from them. Every mistake teaches you where your system needs work and how to improve it. Why do you share all this publicly? Because I wish someone had done it for me when I started. The early days can feel overwhelming and isolating. That's why I share my strategy, my reasoning, and even my mistakes. Because I believe transparency builds trust, and trust builds better investors. Final thoughts. Investing is personal. It's not about having all the answers. It's about asking better questions, staying curious, and taking consistent action. Your journey won't look exactly like mine, and that's the point. You're building something that fits your life, your goals, and your values. The questions in this chapter aren't just about tactics. They're about perspective. They represent the fears, doubts, and aspirations every investor has. I hope my answers have given you clarity and confidence. And remember, the market keeps evolving, and so should you. Stay open, stay humble. Keep refining your approach. Because as you grow as an investor, your wealth and your self-belief will grow with you. If you ever have a question, reach out. The investing journey is a partnership, and I'm here to help you succeed. About the author. My name is Tony Mai, and I didn't come from money. I built my 7-figure portfolio from scratch. No shortcuts, no windfalls, and no insider connections. I wanted to prove to myself and others that anyone can build wealth with the right mindset and strategy. My investing journey began after years of running multiple businesses, from juice bars to manufacturing ventures. Those experiences taught me how to hustle, but they also taught me that working hard alone isn't enough to build lasting wealth. In 2017, I started investing, beginning with a small bet on Bitcoin that changed my mindset forever. That experience sparked a passion for financial markets and led me to dive deep into macroeconomics, investing strategies, and behavioral finance. I eventually earned my master's in finance, determined to back up my passion with real-world knowledge. Today, I'm an elite popular investor on eToro, where I share my trades and strategies with a global community of investors. My approach blends macro analysis, narrative investing, and disciplined risk management, all focused on helping others build sustainable wealth. What drives me isn't just performance, it's purpose. I believe that real wealth is built through education, long-term vision, and community. That's why I created this book, to give back, to inspire, and to show others what's possible when you combine conviction with consistency. Whether you're just starting out or looking to refine your investing game, I hope my journey gives you the clarity, tools, and belief to take the next step on your path to financial freedom. Thanks for listening to The Freedom Investor by Tony Mai. To keep learning and stay ahead of the markets, visit thefreedominvestor.com, where thousands of investors follow Tony's quarterly newsletter. Each edition dives into the global macro landscape, the positions he's building, and forward-looking forecasts you won't find anywhere else. Join the community today and start thinking like a freedom investor.